Inflation in the euro area has fallen substantially from its peak. And we at the ECB are absolutely determined to ensure that inflation returns to our target. But like other central banks, we also find ourselves in an era of transformation. Geopolitical shocks, a changing climate are driving this change, upending our old reality and replacing it with new uncertainties. As central bankers, our role will remain the same as before, ensuring price stability. But the world in which we operate is likely to become far more complex. So at the ECB Forum, in the beginning of July, we will discuss how central banks, including us, the ECB, can best navigate this new terrain. Please join us.
Hello and a warm welcome to day 2 of the forum. This morning, we want to delve into 2 big topics. First of all, the history of monetary policy. Second, we'll be examining why regions, including the euro area, have been hit by low productivity in recent years. The first session, chaired by ECB Vice President Luis de Guindos, will give a broad overview of monetary policy cycles over the past half a century. The second, meanwhile, looks at what the euro area in particular can do to boost its growth potential. That second session will be chaired by the newest member of the ECB's Executive Board, Piero Cipollone. I'd now like to welcome to the stage Mr. de Guindos. Please join us. Thank you.
Well, it was not so difficult. It was not so difficult. Thank you very much, Claire. Good morning to all. It's my pleasure to open the second day of the conference with a session focusing on monetary policy cycles. I am pleased to introduce Christine Forbes. You are a veteran of Sintra. You have been here from the very beginning, no? And Christine will present her work on rate cycles, summarized in an extremely rich paper covering 55 years of data from 24 advanced economies, and what we can learn from this cross-country historical comparison of easing and tightening phases. Her paper will be discussed by Paolo Surico, professor at the London Business School. Well, you know perfectly, you know the housekeeping rules. Christine, you have 25 minutes. You can take the floor now without any further ado, and afterwards you will have 15 minutes more. So,
thank you very much.
Thank you. It's a pleasure to be here today to talk about rate cycles. This is joint work with John Grimha and Ihan Koz. Please raise your hands, say hello. They'd be delighted to answer questions at the end also. So the goal of this paper is to answer the question how today's monetary policy cycle fits in the historical context. And we hoped that after answering that question, we would then be able to answer what the implications are for monetary policy today. So to tackle these questions, we bring together 2 very different methodologies and approaches. First, we're going to draw from the very extensive literature on business cycles to analyze what we call rate cycles. So similar to how business cycles have phases of expansion and contraction, or credit cycles have booms and busts, we're going to look at what we call tightening and easing cycles based on a country's policy interest rates and its asset purchase programs. In using this, we can look at 24 advanced economies for 55 years and identify a series of tightening and easing phases, which together make rate cycles. And this is a neat new database across countries, across time, to try to put today's monetary policy cycle in a broader historical context. But this only gets you so far. It gives you all sorts of neat patterns and characteristics and trends that you can talk about, but it doesn't tell you why cycles have changed over time. So then we have another big section of the paper which tries to understand why rate cycles have changed over time and what drives them. And to do this, we draw on a rich factor-augmented VAR analysis, which allows us to decompose the drivers of these interest rate movements over time and across countries. And what's great about this very rich data set on a monthly frequency is that we can break out in even more detail than, say, the paper we saw yesterday, what the drivers are. We not only look at demand versus supply shocks, which was a subject of debate yesterday, but we can break out global demand, global supply from the domestic demand, domestic supply, versus monetary policy shocks and oil shocks. So a very rich decomposition. So what do we find? We hoped we would be able to get up here and say, this cycle today looks just like this cycle in year X. Unfortunately, it's not that easy. What we found is when we look at this long cross-country track record of rate cycles, there really is no one cycle that is directly comparable today. Instead, it is more like the parable of the blind men and the elephant. According to this parable, a group of blind men are introduced to this new and exotic beast, but they're only allowed to touch one part of this new and exotic animal. And depending on which perspective they take, which angle they take, they come up with very different conclusions on what this animal is like. For example, the blind man that touches the trunk says, it's like a snake. The blind man that touches the leg says, it's like a tree, and so on. Similarly, when we try to categorize today's monetary policy cycle, the one that is the best comparison really depends on your perspective. So more specifically, by some characteristics and some perspectives, this pandemic rate cycle, the cycle from 2020 to 2024, is unprecedented. It was the largest swings in a number of macro variables than we have ever seen. The tightening response was a bit slower than has historically occurred based on the macro data, but then it was followed by the most synchronized period of rate increases in the history of our data. This was also then followed by the longest period at which rates were on hold at their peak in any historic rate cycle. So that as a result, today's rate cycle now is largely normalized, and most macro variables look about where they would look during historic rate cycles, despite these unprecedented moves in between. When you look at the drivers of this rate cycle, it was also unprecedented. The role of global shocks, not only an unprecedented role of global supply shocks, but also an unprecedented role of global demand shocks in driving rate movements during the pandemic cycle. So in those ways, the cycle was unprecedented. But then based on some other characteristics, this cycle was just like some historic cycles. For example, the aggressive path of rate increases by a number of measures was very similar to pre-2008 tightening cycles, including where the level of interest rates is sort of settled at this point in the cycle. Also, the cycle was similar to historic cycles in the sense that demand shocks appear to have driven more of the movements than other sources of the rate cycle. And finally, from another perspective, if you take a step back from the elephant and compare this rate cycle over a longer historic period, focus on longer trends instead of shorter windows, this rate cycle looks like just a continuation of some longer-term, slower-moving trends. In particular, over time, we've seen a larger role for a global factor in driving interest rates. It's increased even more in terms of explaining interest rates than driving business cycles or inflation cycles. And we see an increased role for global shocks over time, and especially a larger role for global demand shocks in driving cycles over time. So based on your perspective, this cycle is unprecedented, just like some historic experiences, or just a continuation of longer-term trends. So what do we do in this paper? This paper, there's a lot in this paper, if you've had a chance to look at it. I'm only going to be able to touch the surface today. What I'm going to do is just give you some highlights from each of the sections, a little bit more on the methodology, especially how we define the rate cycles, and then a little bit more on the shocks driving the cycles. But I'm going to go through some of this quickly, again, just a sample of what's in the paper to hopefully whet your interest and have you look at more of the details, and then save some time at the end to focus on our results based on historic comparisons of how you exit a rate cycle. how long you hold rates constant, when countries have exited prematurely and had to go back into patterns of divergence, leading up to some implications for monetary policy today. Okay, let me jump right in. Key part of the paper is our new definitions of rate cycles. So how do we identify rate cycles? We start by drawing on a standard methodology in the business cycle literature, the BBQ algorithm, which identifies peaks and troughs and measures of activity. But then we set parameters, so we allow for long cycles, as we've had some very long easing cycles post-2008. But we also allow for short phases when countries can adjust policy aggressively over a short period. One big issue when identifying rate cycles is there's long periods where rates are constant. You don't get that when you identify business cycles. So we do have to make some tweaks to the algorithm, and we also incorporate asset purchases as easing. So when interest rates are on hold at lower bounds, if you do asset purchase programs, that counts as easing. So we pull this all together for 24 advanced economies. We're going to look at a period from 1970 through May of 2024. So we stopped right before a few countries started lowering interest rates. That will not be in our sample. One technical issue important for this room, for the euro area, we treat individual members of the euro area as having individual rate cycles through 1998. And then we look at the euro area as a whole based on the rates set by the ECB in our calculation of rate cycles. So pull it all together, we get this neat data set of rate cycles with 212 distinct easing and tightening phases. And we hope that one contribution to the paper is that we'll publish this database of rate cycles, and there's all sorts of different analyses and comparisons and things you can do with this, what we think is the first systematic analysis of cross-country 55 years of rate cycles across countries. So what do they look like in practice? I will show you an example from the ECB, not just because it is our host, but also it is the shortest time series, so the easiest one to look at. So here's what we do for each country in this sample. We graph the policy interest rate in black, and then the purple is the identified start of tightening cycles, the red is the start of easing cycles, the orange is the announcement of major QE programs, and the blue is the announcement of QT programs. And so ECB has had three tightening cycles, the most recent starting in 2022, has hit 2 easing cycles, including a very long one starting in 2008 and going through the pandemic. What's neat is if you track these turning points of the cycles with historic narratives of changes in monetary policy, they fit quite well. For example, this fits quite well the very nice narrative of the history of the ECB's monetary policy written by Philip Hartman and presented at Sintra a couple of years ago. One other thing to just point out for the ECB, you see this little hump in 2011 when the ECB raised rates twice and then quickly reversed course. So in our sample, that does not qualify as a rate cycle because it was reversed so quickly. Instead, in our database, that will count as a preliminary adjustment, where a country tried to adjust rates and get out of the cycle and had to reverse course. We have a whole analysis in the paper about preliminary adjustments, their incidence, what causes them, macro patterns. I probably won't get to that today, but happy to answer questions on it in the Q&A. So that's the ECB. In some sense, that's the easiest one in our sample. Just to give you a contrast, the country with the most rate phases in our sample is the US. You see a lot more rate phases earlier in the sample. One thing I just want to point out about the US is if you see the graph of the policy interest rates in black, the lines look quite different earlier in the sample. And this capture is typical in many countries because monetary policy regimes were very different in the 70s and 80s. A lot more volatility in rates. In the US, there was a period they were targeting the money supply more than rates. But what's great about this algorithm and this setup we've put together is that it does a pretty good job defining turning points in rate cycles even across different monetary policy regimes and targets and tools. Okay, I could show you graphs like that all day. They're fun to look at. They're in the back of the paper. Instead, the point of it, though, is to then look at the characteristics of these rate cycles. So next, we look at a series of sort of standard characteristics from the business cycle literature on these rate cycles. And then we can do all sorts of fun comparisons in how they compare across countries, across easing and tightening phases, et cetera. So lots of graphs in the paper of things like this for anyone who likes random facts. Easing or tightening phases on average are quite a bit shorter than easing phases. Tightening phases last an average of 49 months. Easing phases last an average of about almost 80 months. So lots of facts like that. But what I'm going to do is skip over a lot of them and just focus on the results we have for how the characteristics of these phases have changed over time. So let me jump to that. I have a bunch of graphs like this. We're going to focus on 5 different time periods. The first 2 were before the creation of the ECB, the rest after. The red is the most recent pandemic rate cycle. And we look at some of these standard characteristics of rate cycles across the 5 periods, easing phases on the right, tightening on the left. What you see for easing phases, and we have a lot more data on this in the paper, is there's not a lot of patterns. Easing phases have sort of evolved in some ways, but it's not a consistent pattern since 1970. In contrast, tightening phases show a very distinct pattern, whatever statistic you look at. Tightening phases have become more muted over time. Less rate hikes, slower pace of rate hikes initially and overall, slower overall increase in rates during tightening cycles until the pandemic cycle. During the pandemic, tightening cycle became more aggressive again and more typical of historic rate cycles. And that is also true when you look at what happened to policy interest rates. So this is the graph of the median policy interest rate in our sample for the 5 different periods. Red again is the pandemic cycle. Rates started lower than at any historic cycle, but then were raised aggressively, so they've sort of settled and bounced around what is typical of pre-2008 rate cycles. And the big question then is, of course, will they settle around there or move lower, more similar to the post-2008 cycles? Then we look at a number of macro variables around these rate cycles. Again, focusing on the 5 different periods. Each line, again, different period. Red is the pandemic cycle. We look at a range of macro variables, inflation variables. Here's a sample of 4. Whatever variables you look at, and t equals 0 is the start of tightening phases. So t equals 0 is about 2021 or 2022, whenever each country started raising rates for the red line. And what you see is whatever variable you look at, activity was stronger in the year before the first rate hike in the post-pandemic cycle. So the rate hikes did start slower than they traditionally do during historic rate cycles. But then what's interesting is you see this aggressive path of rate hikes meant that each macro variable has gradually normalized, slower for inflation than the other variables, so that each macro variable has now roughly settled around where it would be at this stage in a historic rate cycle. So even if central banks did start a little slow, they were so aggressive in their hikes and holds that most macro variables have largely normalized, but that is consistent with interest rates largely settling at a higher level than has occurred since 2008. So those are just some of the patterns we find in the data. Now the next task is understanding what drives these cycles. What's behind them, what's behind the patterns over time. So we start by looking at a number of patterns of synchronization of rate cycles over time. This is one graph which shows the share of economies increasing rates in blue, share decreasing rates or doing asset purchase programs in red. You see these waves. The waves suggest that there's some periods where rate adjustments are highly synchronized, where a lot of countries in the sample are doing the same thing. And it particularly jumps out at you as not just a wave, it's more like a tsunami in the most recent rate cycle, where the largest share of economies were raising interest rates at the same time that has ever occurred. Every country in our sample is raising rates except Japan. But there's other periods where you have quite a bit of divergence, different countries adjusting rates in different directions. So what explains these patterns, and especially these patterns where you get highly synchronized rate changes? So to analyze this, we use a couple different methodologies. We do a dynamic factor model. We find that the global factor in interest rate movements has grown quite sharply over time, even more so than for inflation and growth. But what I'm going to focus on is a set of results from our factor augmented VAR. So this is sort of all the bells and whistles and the latest technology. But based on a rich data set, we're able to really break down the shocks driving interest rate movements. And we're going to look at 4 global shocks: global demand, global supply, global monetary policy, and oil prices. When I talk about oil prices, just to be clear, that can also include movements in natural gas prices and other commodity prices, such as the ones that moved quite sharply after the Ukraine invasion, if those prices move in the same direction as oil prices. And then we can also look at the standard domestic shocks. So we're going to look at what drives, and I'm going to focus on the results for what drives interest rates based on the shock decomposition. So let me first focus on some aggregate results. Yesterday, we had quite a bit of discussion of how much of it's global versus domestic. So here's what we found in our estimates. When you break down the 7 shocks, and now we'll just, again, the 4 global ones and 3 domestic ones, the role of global shocks is in blue, domestic shocks in gray, and you see the role of global shocks has been steadily increasing over time, so that in the most recent rate cycle, global shocks explained over 50% of the variation in interest rates. The first time we can ever say that, the first time global shocks were more important than domestic shocks in explaining interest rate movements. If you just focus on the post-pandemic tightening, the role was even larger, explaining 75% of the rate increases post-pandemic. So global shocks matter and matter more and more over time. But what global shocks matter? Now, we had a lot of discussion yesterday about, is it supply, is it demand? Because that could have different implications for monetary policy. So now this is the more detailed decomposition of the drivers of these rate movements over the 5 periods into the 7 shocks. The bottom 4 are global, the top 3 are domestic. And again, you see the increased role of the global shocks, and now you see why. Global shocks played a greater role than they have at any time in history. So the focus on supply shocks makes sense. They were more important, and they were even more important in the euro area than any other country in our sample. So this shows the mean across our sample. Again, there is some important divergence. But what also jumps out at you is that while global shocks played a greater role than they have historically, global demand shocks played an even greater role. So this agrees with some of the results from yesterday, that while supply shocks, oil shocks were important, demand shocks were still more important overall on average across the sample. So that's our breakdown of what drives these cycles. Now let's shift to the big issue on the minds of central bankers is how do you exit a cycle? This is always a challenge, even during normal periods. You have to assess the effects of interest rate changes that are in place. You have to make a forecast, which is always a challenge, and you have to assess how much restrictiveness is in the current state of monetary policy. All hard. So what can we learn from history about exiting a rate cycle? To analyze this, we start by looking at the time that central banks typically hold rates on hold at the end of a rate cycle. And we define on hold as no change in interest rates and having stopped all asset purchase programs. So let's start with the easing phases. Someone jumps out at you. This phase after the pandemic was the shortest period when rates were on hold that has ever occurred historically. On the median country in our sample had rates on hold for only 3 months from when they ended cutting rates, ended asset programs until their first rate hike. What also jumps out is the length of the hold on the tightening end. After tightening rates and raising rates after the pandemic, rates have now been on hold for a median in our sample of almost 10 months. That is the longest period at which rates have been on hold of any historic tightening cycles. And that makes sense. After the aggressive easing, central banks wanted to wait to have more time to assess the effects on the economy. So then what happens after holds? So then we analyze what the pattern is of exits. I mean, here's a neat graph to sort of capture big picture what is going on. So the blue is the share of countries in a tightening phase. The light blue is the share of that phase that rates are on hold before you shift to easing. The red is the share of countries in an easing phase. The light red is the share on hold at the end of easing phases. So there's a lot there, but let's just, in the interest of comparisons for today, focus on the patterns for tightening phases in blue. So what you see is there's been a few periods similar to today where most of the sample are tightening policy. And then typically, after these mountains, where you have most of the sample tightening policy, what we call highly synchronized tightening phases, then you have this sort of blue glacier on the side of the mountain. The blue glacier, though, is usually pretty small and pretty fragmented. And what that shows is typically when you have these highly synchronized tightening periods, you then get this short period where some countries are on hold, some countries keep raising rates, and some start cutting rates, and you get quite a bit of divergence, and then a majority of countries shift to easing. This period, again, stands out a bit in the steepness of the backside of the slope and the size of the holding period. And that captures the fact that, somewhat unusually, you have almost all countries raising rates, then almost all countries shifting to holding rates constant, and it's only now we're starting to shift to more divergence, where some countries are starting to cut, some are still holding, and who knows if some will start raising again. So next, what we want to do is take a closer look at the exits from these big mountains. What can we say about exits from these past highly synchronized tightening periods that might be relevant to today? So when you look at the pattern of exits from previous highly synchronized tightening periods, here what we graph is 0 is the start of the synchronized tightening, and then the dot represents the date or the month when each country did its first rate cut. And the first thing that jumps out at you is substantial divergence. There's often quite a long period between the first rate cut in one country versus when the last country starts cutting rates. So it wouldn't be surprising to see, again, substantial divergence this time around. What also jumps out at you, though, is the red. The red is the timing of the US first rate cut. And the red is usually at the front of the pack. So the US is often, but not always, a first mover in terms of rate cuts after highly synchronized tightening. The only period that looks something like what might transpire today is the tightening cycle that started in 1979 and 1980. And that's similar to this cycle in some ways, when that was another period where oil shocks played a big role. And after that synchronized tightening period, 4 countries lowered rates before the US. So we took a closer look at that episode to try to analyze who cut rates first, who was slower to cut rates, what determines the timing of exit from these synchronized tightening periods. And what we find is your level of activity usually doesn't correspond to when you start lowering rates. What matters more is your level of inflation. Countries with lower inflation tend to be the ones to exit earlier and cut rates first, particularly before the US. And that also seems to apply quite well to today. Okay, I probably will not have time to talk about premature adjustments. Let me just jump to some summary. So we cover a lot of ground in this paper. This is just a sample of some of the results in there. For those of you who like these sorts of statistics and graphs, I encourage you to take a look, especially a lot of implications for different countries. I've also focused only on the medians and means across countries, and there are some important differences across countries. But also let me, before I summarize, highlight what we don't do. We do not look at changes in the monetary policy stance. We focus, our rate cycle measure focuses on changes in policy rates and asset purchase programs. We do that primarily to focus on the main measures that central banks use today, but also because these are easy to measure for 55 years and give us this rich data set. Measuring the neutral rate and overall stance of monetary policy is another whole set of issues, as we will hear about later today. Also, we do not adjust for differences in monetary policy tools and frameworks over time. We do talk some about how changes in frameworks may affect some of the rate cycle characteristics, but we use the same methodology throughout the longer history. We also only focus on advanced economies. Cycles in emerging markets could be quite different. Okay, so that's what we don't do. What do we do? Let's go back to the elephant. How does this rate cycle compare to historic cycles? It does compare or depend on your perspective. There's no one historic rate cycle just like today. In many ways, this rate cycle is unprecedented. The magnitude of the economic moves, the coordinated tightening of rates, the time rates were on hold is unprecedented. But in some ways, this rate cycle is very similar to pre-2008 cycles. The path of tightening, the level where interest rates are stabilizing, where other variables are stabilizing, looks a lot like the 2008 period. But also, this cycle reflects slower moving changes over time, particularly the greater role of global shocks, global supply, and especially global demand in driving rate movements. So the answer of what's the best perspective, it's sort of all of the above. So what's that mean for policy? A number of implications. I will focus on 3. First, as central bankers think about the future rate adjustments, any future rate adjustments, barring a major shock, obviously, should be cautious and gradual. There is uncertainty about what this rate cycle will look like. What is the best historic precedent? If this rate cycle continues to look more like the pre-2008 cycles, especially where interest rates are, that may mean rates may not need to be adjusted very much. We'll discuss that in more detail in the panel again later today, but it does suggest that the neutral rate may have moved up quite a bit. Also, the results based on the shocks behind rate movements suggest that while central banks will obviously adjust based on domestic circumstances, we're likely to see more divergence in rate movements over the next period as we shift away from this highly synchronized tightening phase to the next stage. Second key result is that monetary policy decisions will be increasingly driven by global shocks. Central bankers will focus on, obviously, domestic inflation or activity based on their domestic mandates. But in that context, global shocks matter more and more. So the backdrop will be a greater role of global shocks in driving interest rate movements. And finally, what this also suggests is that it's going to be increasingly important to differentiate behind the drivers of the global shocks. There is a tendency to sometimes equilibrate a global shock as a supply shock, and that has certain implications for monetary policy. You can tend to look through it more. There may have been that misperception during the pandemic when there was so much attention to the supply shocks. There may have been a tendency to think global meant supply, so you didn't have to respond as forcefully with monetary policy. But what we've seen is global demand shocks also play a greater role. So it is increasingly important going forward to differentiate between how much of a global shock is demand, how much is supply, because that will have first order implications for the appropriate path for policy. Thank you.
Thank you very much, Christine. Paolo, now you have the floor. You have almost dovetailed.
Thank you very much. It's an honor to be here and discuss this very nice paper. So Christine did an excellent job in summarizing it. So let me use just one slide to give you the WWW of the contribution. Why, what, and so what. So what this paper does, look at difference and similarity among monetary policy cycle across 24 countries over about 55 years. Why? Because this time feels different. They use a factor model to identify global regularity, and then they plug these into a structural vector autoregression to try to interpret them. What do they find? Look, over time, monetary policy cycle has become more synchronized across country. Expansion phases of the cycle have last longer than tightening one. And yes, indeed, this time is different. There has been an unprecedented coordination both in tightening and holding. And there has been an increased role for global supply shock, but their view is that global demand shock is still dominant. My assessment is also a WWW. Wow. This was impressive, very nice descriptive evidence. So let me try to contribute to the discussion by bringing my own elephants to the table. And by the way, this was totally uncoordinated. We figured it out last afternoon that we were both after elephants. Let me divide between good elephant, which I'm going to call wages, bad elephant, which is inflation services, and the ugly elephants in the room, which I think is fiscal policy. And to play the same game that Christian and co-author have done, I'm going to tie my hands to use the same statistical tools, principal component, and the same international panel as the author. This is the principal component of CPI inflation and nominal wage growth. Remember, those are the mean and standardized, so read nothing about the level other than above zero means above average, below zero means below average. The red line refers to CPI inflation, the dotted black refers to wages. First point to notice, the 70. Very high above average inflation. Wages are very much synchronized. This really seems prima facie evidence of wage price spiral. When wages goes down, inflation goes down. But look now at the recent cycle. Despite CPI inflation being above average, wages have not. And if anything, the correlation is sharply negative. Wages are picking up later than CPI. In fact, if anything, wages are responding to inflation. So that's why in the picture, this is an elephant, but it's not distracting the two central bankers on the sofa that can still make their job. Compare now this with the bad elephant, the one that is disrupting the room. Let's look at now service inflation. It now becomes very difficult because different countries have different time series. So the US on the left since the 60s, the United Kingdom since 89, the euro area for the more recent period. And this is indeed a principal component. For the euro area, the headline inflation in red and the black dotted line is services inflation. Let's start with previous recession. And look at this. Those are three separate recessions. The 70 for the US, the 89-92 exchange rate mechanism for the UK, and the financial crisis for the euro area. But they all share a sharp regularity. Service inflation, globally, and headline inflation are synchronized. They peak at the same time, and they calm down at the same time. But this recession is different. Service inflation peak between 6 months and 1 year later. This implies that there is a period in which service inflation is going up while headline inflation is going down. So actually, in fact, there must be negative inflation to compensate for that movement. This is consistent with the structural reallocation story that Lucrezia, Silvana, and Veronica Guerrieri have showed us could have some bite for the recent episodes. There are some sectors that are becoming more productive. There is a shift in the labor force toward those sectors. There is an impressive in wages demand. Do you remember this match what I showed you in the previous graph, that wages are raising when headline inflation is going down. So still is a bad elephant because means services and inflation might be more persistent than we thought, but it's not as bad as we think because if this is a better allocation of capital, then monetary policy can afford to be more accommodative of what we would have otherwise done. Unfortunately, however, there is a very ugly elephant, and you can see for how painful it is for the central banker in the picture. What you see as a red line is the principal component of CPI inflation, and as a blue line is the principal component of GDP growth. The dotted black line is the first principal component of fiscal deficit. A first point to notice, in the 70s, fiscal deficit has been on average. So I don't think we can explain the 70s inflation with fiscal sustainability. Look, however, the great financial crisis of 2007-2009. GDP growth goes well below average, and fiscal deficit becomes expansionary, very much below average. Then, however, there is the austerity, and despite the slow recovery, look at the fiscal deficit that shrink actually become a fiscal surplus. Slow recovery becomes even slower, but look on the right chart, there is no inflation. Contrast this now with the 2020-2024 cycle. The fiscal deficit expansion, it is as big, if not bigger, much below average than during the financial crisis. However, because of the pent-up demand, the output loss is much lower, if anyone, relative to the global financial crisis. And still, fiscal deficit is below average. This is the denominator that is growing a lot because of pent-up demand, but the numerator of the fiscal deficit to GDP ratio is not moving. There is no austerity. There is a soft landing, but CPI is picking up. Remember that monetary policy in the two cycles has also been very different. Accommodative monetary policy was much more prolonged during the financial crisis, in the aftermath of it, than it has been now. So yesterday, Jordi was saying, how about if the aggregate demand has rotated because of accommodative monetary policy this time? And Giorgio pointed out that, if anything, monetary policy has been more accommodative in the aftermath of the financial crisis rather than the pandemic. So my challenge for you, Jordi, is how about if the rotation in the aggregate demand is due to accommodative fiscal policy rather than monetary policy? There is a lot of discussion, policymaker, academics, what would have happened if interest rates were cut 6 months earlier. Look, but they were low for longer after the financial crisis. My instinct is that cutting interest rates 6 months earlier would have not made such a big difference. However, the question for you is, will tighten fiscal policy? If fiscal policy would have tightened 6 months ago, would have inflation been different? In other words, President Lagarde, Governor Bailey, is there not here perhaps a trade-off on the one hand between slow recovery and no inflation, and on the other hand, soft landing and high inflation? Could it be that the trade-off faced by monetary policy is fiscal in nature? You might say, okay, those are correlation. Let's distinguish them from causality. So I'm going to rely on my own research to do this in the next slide. Tom Sargent said that the virus was the Third World War because it was a common enemy, because the size and breadth of government spending was as large as during the war. Just to give things in perspective, the Marshall Plan was 4% of the US GDP in 1948. The US, the UK, and the euro area public spending has been enormously larger than that. So here I'm using US data for 125 years of data in a joint paper with another fantastic PhD student. We are very lucky to have a London Business School, and it's going to be on the market next year. We use government spending instrumented by Ramey military spending news. So this is not Moritz war shock that destroy a country. This is an exogenous movement in government spending for a war happening somewhere else. Government spending peak for 4 years, and then it goes to pre-shock level. This is financed with debt, as you see in the fiscal deficit coming in the middle chart. But look at the right panel. This is the impulse responses of log prices. So this is the slope of these impulse responses is inflation. Inflation in the first 4 years, which is as much as the fiscal expansion lasts, increased by 0.5% for a shock that has the size 1% of GDP. Let me make a back-of-the-envelope calculation. Euro area government public spending has increased by 6.5% in 2020. According to our estimate, this has contributed between 2.5 and 4% of euro area inflation between 2022 and 2023. 1/3 of euro area inflation. In UK and in the US, where fiscal expansion has been even larger, we go closer to 50%. So my question is government expanding inflationary or not? What we show in that paper, that depends on the composition. The beauty of, is a terrible word, beauty, I apologize for that, of military spending, is that it has a composition of government consumption, government investment, but above all, tilt government spending towards public R&D. So in the short run, government consumption act quickly and move output and inflation in the same direction. Oh, this is a different one. I wanted to point it out. You see in the first part of the horizon, output goes up and prices goes up. So it looks like a demand shock because this is mostly government consumption. But in the long run, the investment in public R&D take it over. There was DARPA during the war. 10 years later, we have internet. There was the Manhattan Project. 15 years, we have nuclear energy. There is moon shooting. 10 years later, we have GPS. So when fiscal policy is tilted towards public R&D, this looks like in the long run a supply shock because push up productivity and bring inflation down. So what is my bottom line? What has been the legacy of the 70 inflation? A few years later, the theory and practice, or better, the practice and theory of inflation targeting come about as a legacy of the 70 inflation. Then the financial crisis occurred, and what has been the legacy of that? Take it seriously, the financial sector, and bring in banking into our model, into our framework. I wonder what's going to be the legacy of the pandemic crisis. Let me tell you my wish, if not a legacy, that we abolish this demand and supply shock decomposition, that we stop orthogonalizing short run and long run, I don't think it's useful. I think actually it's been very confusing during this crisis. If I look at the recent inflation episodes, I see three factors, three large movements: energy prices, structural reallocation, and fiscal policy. 2/3 of those explanations are both supply and demand and affect both the short run and the long run, especially in countries in the UK in which the recent increase in public spending has been particularly shifted towards public R&D. So perhaps what we need to look at are two shocks that put inflation up and shocks that push up productivity. And in this small discussion, I've given two examples, structural reallocation and fiscal policy, that they do both. They push inflation up in the short run, and with the right composition of public spending, also put productivity up in the long run. But then if you buy my interpretation, then the monetary policy responsive of hiking interest rate first and then starting to cut now, then just perhaps it has been about right. Thank you very much.
Thank you very much, Paolo. I think that is very important to bring the fiscal dimension to the discussion. I don't know whether, Christine, do you want to comment?
Sure. I have lots of thoughts, always. Actually, I have a couple of comments. So first, I think your addition of wages and services to some of these comparisons is super interesting. We talked about what variables we focused on. We look at GDP growth, IP growth, unemployment, employment growth, CPI inflation, and core inflation, mainly because that's the best time series, monthly data back to 1970, and even those series are pretty spotty. If you go to wages and services, it's even harder. But I think yours is a nice supplement. If we want to do it on a lower frequency, you could work that in. I like the way you broke out the role of government spending as a demand shock. So we sort of go the next level, just cycle characteristics, and then these broad categories of shocks, we find big roles for demand shocks, but we don't say what those demand shocks are. We separate that from monetary, and yours is then the next level. A lot of demand shock is probably fiscal, so that's another sort of nice extension to explain this large role for demand shocks we have. So I think one important thing to highlight that might get missed for people who haven't dug into all the details of this is some of your results were also of the role of these shocks in influencing GDP and inflation. We have all those results in our paper, but I didn't show those. The ones I focused were on how these shocks affect interest rates. And there are some periods where there are very big differences in how the shocks affect, say, inflation versus interest rates. So, for example, some of the disconnect we heard yesterday of what's the role of demand, what's the role of supply. Supply shocks have a bigger role affecting inflation, a smaller role affecting interest rates as we look through some of the shocks to inflation. So that's where there's also it's something to just explore more and really be clear on is when you're looking at the role of shocks, what are you explaining? You get different roles for different shocks based on that left-hand side variable. And then finally, I think your bottom line is also we just need to do a better job of explaining what's going on underneath. Yet using the sort of Favre decomposition, supply, demand, global supply, global demand, it's far from perfect. It's lots of assumptions. There's a lot that goes into the guts of this, for sure. Sometimes that matters. Some of the results, it doesn't matter. But I fully agree, ideally you'd like to then go another level, understand more. But our bottom line is we still need to do this decomposition because it does matter first order for setting policy. But you're sort of coming in the same place. We need to do a better job of understanding what's going on under the covers, and that's where we need to go.
Well, thank you very much, Christine. I will take advantage of my position. I will ask you one question. Yeah. I think that fiscal is key. I agree with you. And we have seen as well a very important deterioration of the fiscal profile in Europe, in the US. Do you think that this could give rise in the future to any sort of fiscal dominance and affect to the rate cycle?
That's beyond the scope of our paper, for sure. I can give you my personal views. I have great faith in all the central bankers in this room that as long as they maintain independence, which we hope they will stick to their targets and stick to their mandates. So I hope we will not be in a world of fiscal dominance. Yes.
Very good.
My take is that there's nothing wrong about running a large fiscal deficit. The problem is that what you do with that. If you run large fiscal deficit to fund public R&D, be my guest, this could pay themselves. if you use a large fiscal deficit for government consumption or for even industrial policy that in our paper we show have strong inflationary effect in the short run and very little productivity gain in the long run, then I'm a little bit concerned. So it's not the size of the fiscal deficit per se, but the composition. And to me, this is a critical message to take away. When I hear all those unspecified industrial policy, I'm worried this could be a big demand shock in the short run, using the conventional terminology, and a little supply shock in the long run. And if I might go back, I can understand that it's very easy for communication, talk about demand and supply. But I really think that our focus is what moves inflation in the short run and what moves productivity in the long run. If you start to see history and our economic model through this lens, then you go to the fundamentals. Okay, let's look at the composition of government spending. Let's look what is the impact of labor market on those two variables along these two dimensions. And then I think the job of monetary policy becomes easier to think about. And this was the message I wanted to try to put forward.
Well, thank you very much, Paolo. Now the floor is open. I have, to Jordi. We'll start with Jordi there, or whatever.
Okay, well, thank you. I thought this was a very interesting paper. There was one picture that you showed that I thought was absolutely fascinating, which is the behavior of inflation around interest rate cycles. For 3 of the sample periods, it was completely flat. And it only showed some hump-shaped for the most recent episode. The fact that it was completely flat for the 99 2000 episode, I think it's proof of success of monetary policy. The fact that it was hump-shaped in the recent episode, it's proof that this was the first adverse supply shock in an inflation targeting period, and hence that there was some inflation that the central bank had to accommodate. But what I thought was more fascinating is the fact that it was completely flat in the earlier period, which shows that since we know that inflation fluctuated a lot, that monetary policy was completely orthogonal to inflation. Okay, so it gives a very interesting new perspective on the literature on monetary policy reaction functions from a very different point of view. No? And just a quick comment on Paolo's evidence. Is government spending inflationary? Well, I would say the answer to that question is not independent of how monetary policy reacts to government spending. When you use empirical evidence with data going back to 1890, okay, so presumably monetary policy now is very different from what it was before, as their paper actually shows.
And we do control for data sample analysis exactly for that reason.
I have here Joaquin, and there are 2. Let's collect 3 questions, and we can respond afterward. Joaquin.
Thank you very much for these excellent presentations. Let me come back to the synchronization of monetary policy and your database. Over the last 55 years, the world changed a lot. And I ask myself about the time consistency of this synchronization. Isn't that pretty much dependent on what happened over the last 55 years in terms of globalization? And could there be maybe now coming a kind of a new period where maybe deglobalization, we do not really know if that is the case, but take that assumption it could be, is now kicking in, and this might lead to further desynchronization? Maybe this is the question for you. And maybe it's more an observation over the last couple of 2 years. When inflation is getting above 10%, I have to admit, from a central banker perspective, it doesn't make too much difference if it is supply or demand driven.
Let's take another question there, and you can respond afterwards.
Yes, so fascinating paper, and
please go to the point. We have only theoretically 2 minutes.
I'd like to go a step further. The sharpness of the cycle now compared to earlier times is due to waking up from complacency, or is it due to large shock? And that's something you could look at. So let me juxtapose three chairmen here. I'm thinking Volcker, I'm thinking Greenspan, and I'm thinking Lagarde, Powell. Let me put them both in the same basket. So when Volcker came in, inflation was rampant, and Volcker said, I have to do something, and sharply increased interest rates. So that sharp cycle was a result of complacency of monetary policy before. Greenspan was always applauded for being ahead of the game and doing things in monetary policy, kind of akin to what Jordi said, before things were a problem. Now in 2021, I think in 2021, the signs were on the wall, but the central banks had their eyes elsewhere on other goals that aren't goals of the central banks. There were lots of people that claimed the shocks were transitory. The shocks were large too, so you have it maybe both ways. But it seems clear that the interest rate rise came way after the inflation started to rise. So it seems there's a parallel, maybe more to Volcker than to Greenspan, and I'm wondering whether you'd be willing to comment on that.
Yeah, Christine and Paolo.
Okay.
Let's try.
I'll be quick. Jordi, your comment on the graph where the inflation path is quite flat for most past historic cycles, isn't it? That's the graph that generated a lot of comments already and from feedback from Sintra. Just a couple points on that. One is that is also the median and averages. When you do it for individual countries, you do get more dynamics. In some cases, not all though. But overall, you're right. There's a number of possible reasons. One is a flatter Phillips curve, and one is just that monetary policy has largely worked pretty well in the past. We sort of see what's coming, you adjust in advance, and then you flatten the effect on inflation. So that is definitely consistent with that. I'll jump to Harold. Your comment, I don't think we can sort of comment on the strategy. One comment, though, is the easing cycles have largely gotten longer. So it is just the tightening cycles that are shorter. Whether that is complacency or large shocks, that's a great research question that can now be answered with this database. So I'm happy to share it if you want to dig into that. But then that also actually leads to Joaquin's, your question. The synchronization, what drives it? And also, again, the patterns of the cycles. There's increased globalization, increased role of global factors, but that can be broken into two components. It's larger global shocks, which we document, and it's a larger similarity in the responses of central banks to a given global shock. So those two drivers are important. And then looking and why are we all more connected? Sure, some of it is increased trade and globalization, but the role of the global factor increased even before the period of hyperglobalization. So I think there's more to it. I think some of it may be shared frameworks by central banks, some things like that will probably not go away. But if you look again at what drives this increased global factor, large global shocks, even if we do desynchronize or break into groups, probably won't go away. We might get even bigger global shocks. Will central banks still respond in similar ways? That it's not clear how that will evolve, but I'm not sure. I wouldn't expect this pattern of increased global factors to fade, given that some of it is just the size of the global shocks, which are bigger, and the world is still going to be very interconnected, even if it's interconnected in different ways than it is today.
Paolo.
A quick word just to clarify with Georgie. Is government spending inflationary? Depends on the composition. And depends on monetary policy. On the composition, we find that if it's tilted towards public consumption and to a less extent to public investment, is inflation in the short run. If it's tilted toward public R&D, we found that it is not inflationary, actually, if anything, is deflationary in the long run. And yes, monetary policy is super important. If we don't have interest rate, we get very different result, but we do have interest rate and we look at different subsample, so you can think of this result at the net of the historical response of monetary policy.
Thank you very much, Paolo. I think that we have time for two more questions, a couple of questions.
Thanks a lot. Great presentation, great discussion. Christine, I thought the results on the increased importance of global shocks was very interesting, and I wonder if you thought about the role of, more specifically, the role of commodities in general for those results. So there are a number of papers showing that there's increased correlation across commodity prices due to financiarization, etc. And so I wonder if that could play a role, and this is also important in the sense that there is also some evidence that commodity prices might be correlated highly with inflation expectations. So I wonder also if you have any evidence internationally about the correlation of expectations and at the short end and also at the long end?
And Philip, we finalize with you. But to the point, please.
The speed and size of transmission monetary policy depends on private debt to GDP and also on the fraction of private debt that is at floating rates as opposed to fixed rates. So those factors could well influence the size, the length of the cycles that you're looking at.
Very good. Philip?
So I thought this was a very good paper, and as you said, Kristen, it's going to feed a lot of future research. And one element, which I don't think you can answer now, well, unless you find a very good way to do it, is the trade-off between the peak and the hold. Because essentially, it's always debated, do you go up more steeply, knowing that that may bring inflation down more quickly, and therefore the hold would be lower, versus maybe having a lower peak, but then needing to hold it for longer. So I don't know in the history of this what you can do about it. And as you say, you're not measuring the stance here or the kind of counterfactual, but just I suppose coming to what Harold said there, like in 2021, absolutely we did have a sense for a lot of 2021 that with the bottlenecks, basically inflation would fall back as supply picked up. Now you can argue about whether that was a misdiagnosis or not. But of course then there was a second shock in early 22, and it's really the sequence of shocks between 21 and 22, which is I think important for the real-time analysis. So this goes back to I mean, I think what you've done is all very sensible, but maybe within this data set, there are also ways to think about the different phases, because it's not just about turning points. It's about going from accommodative to normal, from normal to tight, and back again. And that kind of more granular analysis is for the next time, I suppose. Okay.
Okay, Christine.
Yeah, I can be very quick. These are all fantastic suggestions we haven't done. Your inflation expectations over 55 years, good luck. That would have to be a much narrower analysis. We did think about commodity prices, but you really can't identify those separately from oil. I think a lot of that is in the oil shock there, but you could definitely dig into that further. A speed of transmission, how long you hold versus how aggressively you tighten. Those are all great questions, which I think are great for the next paper. We now have the data set that you can then analyze that, but I figured after 90 pages, that was probably enough for this paper, so that will be the next assignment.
I want to just second the John Mulbauer point. I think it's spot on. We know of international evidence showing that countries with higher household debt to GDP tend to have a more amplified business cycle and to have larger response of monetary policy, and they have more variable rate, it is faster. So actually this could be, and there are available data for your country and your panel for household debt to GDP, so it could be a nice addition to look at. I think it's a very good suggestion.
Thank you very much to both of you. Without further ado, Piero, you are going to take the baton now, and you deserve applause.
Thank you. Very good. Well done. Yes.
So good morning, everyone, and welcome to this section where we will discuss euro area productivity in the short and the long run. I don't think I have to spend too many words to explain why this session is important, not just for monetary policy, but I would say for the welfare of the European citizen. However, for those of us that have been distracted lately, let me remind just two numbers. The first number is 8.6. The second number is 3.5. These two numbers is the rate of growth, the cumulative rate of growth of the US in the euro area from the last quarter of 2019 and the first quarter of this year. Now, this large gap has been driven essentially by the dynamics of productivity. Productivity in the US grew by 6.3% over this period versus 0.7% in the euro area. I think we have to, pose some question here. First of all, what are the factors behind this gap, which is larger than what we have seen before the pandemic? Second question is this poor performance of the euro area cyclical or structural? What is even more important, how is it going to unfold in the future, especially looking at the challenges that the euro economy will face in the coming years? I'm thinking to climate change, I'm thinking to demography, I'm thinking to the next wave of IT innovation, I'm thinking to geographical risks. Today, we are well equipped to discuss this important topic because we have with us two very distinguished scholars. We have Professor Antonin Bergeau, who he will set the stage of our discussion by presenting his paper that is titled The Past, the Present, and the Future of the European Productivity. And then we have Professor Kalina Manova, who will discuss Professor Bergeau's paper. Let me briefly introduce the two speakers. Both of them have impressive and very long CV, and we would exhaust our time if I had to go through them as they actually deserve. So in the interest of time, let me limit myself to the essentials. So Professor Bergeau is a current associate professor of economics at HICEC Paris, while Professor Kalina Manova is professor of economics at the University College of London. Before moving to the substance of the matter, let me remind of the rule of the game. So Antonin, you will have 25 minutes to present your paper, and then Kalina, you will have 15 minutes to discuss it, to make your consideration. At the end, Antonin will have three minutes to try to reply, and this should leave us 15 minutes for answering for questions from the public. So, Antonin, the floor is yours.
Okay, so thanks a lot for the great introduction, and I'm very honored and pleased to be here today to talk about European productivity and European growth in the long run. So when we think about growth in the very long run, we can keep this number in mind, 2.1%. This is the average GDP per capita growth in the euro area. It's exactly the same number that we will find in the US since 1890. But contrary to the US, where this was extremely stable over time, in the euro area, what you see is that most of those gains were concentrated over a 3-decade period, during which consumption per capita was multiplied by 3, while we managed to reduce working time by 400 hours on average per capita. But since then, growth has been progressively declining, and since 1995, the average GDP per capita in euro area is 1.1%, and since 2004, it's only 0.7%, which has been challenging for public policy and monetary policy. So if we want to introduce productivity into this picture, there is a very simple way to do it. It would be to state that GDP per capita is equal to GDP divided by unit of labor times the number of units of labor divided by population. And since 1890, we managed to get 20 times more efficient in producing 1 unit of value added. And how did we decide to split this? We multiplied GDP per capita by 10, and we divided our working time by 2. And so to understand the dynamic of GDP per capita, it's very important to first think about what are the productivity gains we can expect. Then we can think about how these gains could be redistributed between consumption, investment, that would be GDP per capita, or leisure and less working time, that will be the second term. So in this paper, in this presentation, I want to talk in 23 minutes about 200 years of data, spanning the GDP per capita in Europe over the 20th century, and in particular explain what happened during the 50-80 exceptional period and why didn't we manage to continue this exceptional period of growth. Then I will focus on the reason behind the slowdown since 1995 and discuss the future of European productivity around essentially one question about the impact of artificial intelligence in the near future. Okay, so let me start quickly about this very long 1890-1995 period. So there's another decomposition that we can use that is very convenient to understand the dynamics of GDP per capita. We can split GDP per capita into 4 different terms: TFP, capital intensity, employment rate, and average working time. And if we implement this decomposition and look at the average growth rate over all this period, what we see is that, unsurprisingly, population is what drives most of GDP in the US, much less in euro area, by the way, but TFP is what, the yellow bar is what remains the most important factor explaining the long-term development of GDP per capita in most of the country for which we have data. We can go a little bit further and use this decomposition to look at the difference between the euro area and the US. So what you see in this picture is the relative GDP per capita in the euro area compared to the US. If you sum all the bars in a given year, you will get to this relative gap. And what you can see is that if you start in 1950, right after World War II, there is a huge differences in terms of GDP per capita between the US and Europe, and this is essentially driven by differences in TFP. It's of course because Europe was just exiting World War II with a lot of disruption, but also because the US experienced a very significant productivity wave that started in the 30s and continued up to the 50s. And as a result, what you can see is that this yellow area, which captures the difference in TFP between the two regions, really disappeared over this period of 30 years. So essentially, all of the growth that we see in those in these periods is due to the euro area resorbing its TFP differences with the US. And then after 1975, what happened is that the negative relative contribution of employment rate, the green area, started to appear, and also a working time declined faster than the US. So the point is that after 1970, we really started to implement our preference for more redistribution and more leisure. But the issue is that at the same time, we started to fall behind the US in terms of TFP. And that means that we cannot have growth in that case because there is no TFP gains to finance this declining working time. So what made this catch-up possible? There's, of course, a lot of investment coming up, and that's how you can increase GDP through this capital deepening effect. But also Europe increased its total factor productivity quite significantly, relying on 2 important factors. Europe had a very educated population relatively to other regions. They also massively adopted US technologies. And the share of US firms in French and German patents, for example, increased from 10 to 25%. And this is essentially driven by superstar manufacturing firms from the US. And so, in a way, it was easier to grow at this time because all you had to do was to adopt technologies that were created in the US, and we know that this creates a lot of spillovers and generate follow-up innovation in the euro area. But Europe also relied on an almost unlimited supply of energy that's coming from oil, and that stopped in 1975. So when you cannot use those leverage to continue to grow, what can you do? You can rely on innovation policy. And the fact is, during this time, Europe didn't really implement an R&D policy that will allow the euro area to follow up with TFP improving innovation after 1970. Public investment, if we compare to the US, public investment into R&D were not coordinated enough across country and not enough mission-oriented. To give you a brief picture of what the US did, and there is a nice poster in the lobby about that, federal R&D expenditure in the US were almost 2% of GDP in the 60s. the NASA alone represented 40 billion US dollar, and that created massive spillovers, including to technologies that were far away from the direct implication of those investments. If you look at Europe innovation policy during those decades essentially rely on the development of national champions, which somehow worked, but they also couldn't benefit from the large market that the US had. It's also very riskier innovation policy. The failures are very costly when you invest everything in the same candidates. It limited the entry of competitors, and they also face competition from the US and then from Japanese firms. And as a result, Europe as a whole couldn't switch from its growing drivers during those 3 decades to a country or a region that would be able to implement new technology. And Europe as a whole missed the IT revolution. We can see it by looking at the trend of TFP. You see the blue line in the US. You can see this small wave in the 90s that's essentially driven by IT technologies. This is not something that we experience in Europe. And there's many other evidence in the paper that show that European firms didn't implement IT in a way that would generate productivity gains. So let's now move to the past 30 years. So as a result of this missed IT revolution, and unsurprisingly, labor productivity in the euro area and the US were diverging from 1995. This divergence stopped after the great financial crisis, and the relative level was maintained at the same position. But then after the pandemics, and this is the number that Piero remained, there is this relative decline of European labor productivity compared to the US. Actually, if you look at deviation from the trend, it's even more worrying in the euro area. We are really falling behind our pre-great financial crisis trend. So why is that? So there's many different candidate causes. There are short-term causes. And probably the most obvious one is that those shocks that we faced recently, the pandemic, the Russian invasion of Ukraine, they happen in a context where unemployment in the euro area was very low and firms faced historically high hiring difficulties. And as a result, firms reacted to these negative shocks by adjusting their output much more than their labor. And they kept the workforce in the firm to some extent. So when the output declined more than labor productivity declined mechanically. There's also geopolitical risk, and we discussed that yesterday, and disruption of global value chains as a result of international tensions. This had a very strong impact on productivity because they will impact much more firms involved in international trade, and those firms are much more productive than others. There were also some questions about potential zombification of the economy that comes from policy support during COVID. And the worry is that this support will have created, will allow firms that are not productive enough to survive due to the support. I think this is, in the past quarter, this has been completely offset by an increase in exits, but this clearly created a drag in productivity before. But in fact, on top of those short-term causes that are likely to resolve in the next quarters, there are structural causes that are much more worrying. First, seems to be a structural reduction in working time in Europe. If you look at deviation from the pre-pandemic trend, we are now 10 hours below, on average per person, 10 hours below what we used to work. And it doesn't seem that this is catching up to the pre-pandemic trend, so that could capture change in preferences. But what I really want to discuss more is this idea that R&D expenditure is clearly misallocated in Europe. And that creates what we call a middle technology trap. So let me briefly tell more about this misallocation of R&D. R&D expenditure in the euro area are at 2.3% of GDP. This is much less than in the US. This is basically the level of China, but China is trending up while Europe is not. If you look at public R&D expenditures, in fact, it's exactly at the same level as the US. So it's not necessarily an issue of public spending. It's not an issue that we don't spend enough into R&D. It's mostly an issue about who benefits from this public spending of R&D. And in fact, in Europe, if you look at the biggest innovator, you would find that it's very much focused on what we call sometimes middle technology. So let's look at top patenting firms in 2005 in the US and in the euro area. In the US and the euro area, you find very famous manufacturing firms, and in the euro area, Siemens, Bosch, Ericsson, Philips, Bass. It's mostly chemical and appliance manufacturing. Now let's move to 2023. You can see really clearly that the US made this shift toward digital technology producing goods. And what happened if we look at Europe, we find the exact same firms that we did in 2005, except that Siemens was replaced. So that's an issue, the fact that we couldn't manage somehow to generate an innovation policy that would allow us to make the switch that happened in the US, and that most of the R&D spender in Europe are still producing goods that existed 20, 30 years ago. There's many, many more evidence on that. We can look at global patenting. This is international patents, so you can compare regions. You can see that Europe is falling a little bit behind as a result of China taking over after 2001. But if you focus on high-tech patents, that would be mostly digital technologies, biotech, and AI, Europe is almost non-existent. It's back to 10% of total patent. And by the way, this includes the UK. So if you just look at the euro area, this number will be even below. So we are really not so good at producing high technology, and it's not so clear why. And there could be, many reasons that are the same, that the reason that explain why we missed the IT revolution a few decades before. European innovation policy are still not sufficiently coordinated. The benefit, the advantage that we have in Europe, the large market, are not exploited enough. We probably don't use capital market. I know there are many discussions about using integrated better the capital market across different regions, but at the moment, it's not working sufficiently well. But also the tools that we use, the R&D subsidies, the tool that we use to incentivize firms to innovate, are known to be particularly inefficient. Why is that? It's because it's very hard to direct R&D expenditure, R&D tax credit to the right firm. And by right firm, I mean the firm that will be able then to generate productivity-enhancing innovation. Those firms that have the capability to transfer R&D into productivity, they probably have some characteristics that are very hard, if not impossible, to observe. So when you direct R&D subsidies to firms based on their size or based on their age or based on the sector, it's very likely that you will give too much R&D tax credit to firms that are not necessarily the best one that should receive this allocation of R&D. There's another tool that we know is very efficient, and I think we should rely much more on it in Europe, is to bet on the spillovers from the public to the private R&D. And in fact, we know from history that this spillover can be quite substantial. We have evidence from the Cold War in the US. There are those massive investments that was done by the federal government into the NASA and into military projects. They generated huge innovation gains and huge productivity gains in the private sector, even decades after they stopped. And there's also successful examples in Europe. When you give subsidies to good laboratories, it generates spillovers to the private sectors. And in a way, it's, this trick of betting on the spillovers from the public to the private sectors is a way to play around this idea that R&D subsidies are very hard to target. If you give the money to laboratories, then you will only have firms that are able to exchange with laboratories and to benefit from the spillover that will generate productivity and innovation out of it. So I think this is the kind of policy that we should implement much more, and I think this is something that the US is much better at doing as we are in Europe. Let me just finish this part by saying that one of the additional reasons why I think we should really bet on this tool is that, in fact, while Europe is not so good in terms of patenting, and I showed you some aggregate number, but we can do it technology by technology, Europe is actually very good, or relatively good, at producing the basic knowledge that is usually done in university that goes into feeding those patents. So this is to give you the share of paper, academic paper, that have been produced country by country, and that are used in patents that are then, protecting those inventions in those 6 chosen technologies that are representative of, new high technologies. So while Europe almost has 0 patent in those technologies, they still produce 25 to 30% of the basic knowledge that is used in those technologies. So it's not an issue of, again, R&D expenditure. Globally, we spend enough, at least from the public side. It's not an issue of the quality of our researchers. It's really an issue about scaling up and getting into commercializable applications. Okay, let me talk now in the remaining time about the future. And I essentially want to talk to you about AI. What can we expect from artificial intelligence in terms of growth? So AI can impact growth through many, many channels, and this is why we think of AI as a general purpose technology, very much like the one we had in the past. AI can impact growth through the automation channel. So AI can automate some tasks that are not so core for my work, and so they can free up time for me to work on more creative and valuable activities that could potentially generate some additional productivity. AI can obviously also enhance my efficiency by complementing me in the task that I'm doing. I can, translate things faster. I can write better codes, improve my writing in English. AI, and that's also an automation channel. But AI can also automate the production of ID or generate new services, new good and new development that were impossible to reach before the technology existed. And in fact, if you think that AI can even automate or improve R&D productivity, then the potential gain that you could get from adopting AI could potentially be extremely large. And finally, AI will substitute some labor with capital, and that creates a capital deepening effect that we know generates growth. Okay, let me first talk about the automation channel. There is a recent contribution by Daron Acemoglu that offers a very simple way to estimate this automation channel derived from a task-based model. Essentially, what you need to do is to multiply those four numbers. The share of GDP that is accounted for by exposed tasks, exposed to AI, the share of this task for which it is cost-effective to use AI, the average saving cost from adopting AI, and then the labor share. So let's try to put some number in each of those. First, what is the share of tasks, the share of occupation that are going to be impacted by AI? To understand this, it's very important to define an occupation not as a monolithic object, but as a continuum of tasks. Some of these tasks are very much exposed to AI. Some of these tasks are very hard to automate. And as a result, occupations are going to be ranked, this is the y-axis, differently in terms of how much they are exposed to AI. If you look at the accountant, telemarketer, or secretary, those are occupations where AI is very good, and especially generative AI is very good at doing the kind of task that those occupations are doing. If you take a baker, for example, AI is not going to be too good at producing those tasks. But on top of that, there is an additional dimension, which is the fact that even though AI can technically replace you in some of your tasks, it must be very risky, very inefficient, or very costly to do so. If you think of a physician, for example, there's many things that AI can do. Radiologists can be very well complemented by AI, but in fact, that will be very costly in most of the case, and it's very unlikely that physicians are going to disappear completely as a result of AI in the near future. So when we integrate all this, we can rank occupations in this two-dimensional graph, and I will get to a number that I will tell you in a minute. But before that, let's try to find a measure of how much more efficient we are when we use AI in the tasks that are impacted. So again, this is only on tasks where AI can automate what I do, and where it's cost-effective to actually implement this technology. There's some evidence from the literature, essentially using generative AI and using RCT, that shows that workers that use generative AI in their work tend to be faster. There's, for example, a 40% increase in how fast it is for analysts to produce reports. They tend to be more precise in forecasting competition. Actually, the forecaster using AI are much more precise than others, so that could be interesting for some of you, I guess. And also more creative. There's competition where they ranked story written with AI and without AI, and in fact, the one written with generative AI are considered to be more qualitative. There's still also some negative impact. So there's evidence in the literature that workers tend to trust too much AI, including in tasks where AI is not so good and actually not much better than human in doing the job. Sorry. And that's particularly true for radiologists. We realized that, in fact, radiologists that use AI tended to believe too much what the AI was saying, and as a result were actually less efficient than radiologists that didn't use AI. So to go back to this decomposition and give you some number, I have much more detail in the paper into how I get to this, but just to give you an order of magnitude, you can think that there's 45% share of GDP accounted by exposed tasks, but among those 45% of tasks, only 40% of them will be cost-effective to automate. And among those tasks that are both cost-effective to automate and exposed by AI, I assume that there is a 35% increase in efficiency, and then we multiply all this by the labor share, and this is how we get to this number, which is how much we can expect in, let's say, the next 10 years in terms of gains from adopting AI. And again, this is, so we get in the euro area on average cumulative 3 percentage point increase in the next 3 years. which, it's not zero, it's not substantial, it's certainly much less than what we expected ex ante and what we experience with other technologies, general purpose technologies. But it's important to keep in mind that this is only the automation channel. This is only what you get from adopting existing AI, which we know can be adopted as almost zero cost. So it's very likely that these are gains that we are going to experience in the near future. But in fact, most of the gains from AI, they are not coming from this automation channel. They are coming from our ability to use AI to produce new ideas, produce new services, and produce new goods. But to do that, this requires massive investment into this technology. It requires to be at the technological frontiers, and it requires to have firms that have the capability to adapt AI and to completely transform their way of production. And here again, if we look at where Europe is standing in terms of being at the frontier in terms of AI, it's not completely catastrophic, especially if you compare to other high technology, but looking at patents, Euro area is already lagging behind with the US and China quite significantly. And although there are some startups and some models that are developed in Europe and are very promising, and although we also have evidence that European firms adopt AI at the same rate as American firms, the fact that we are still second mover into producing those technologies, globally speaking, is a bit worrying. But here again, there is this paradox that if we look at the academic paper on AI, weighted by citations, the paper that are used by engineers to create those models and those AI tools, if you pile up every European country, you get to 11 million citation weighted paper. This is almost the same as the US. So again, it's not that we don't have the knowledge to create this model. We actually do have the knowledge. What we fail to do is to convert this into patenting and into firms that will be at the frontier in producing AI. Now, in the last minute I have, I want to quickly talk about green transition. So I won't have time to get into much detail. What I just wanted to see here is that, if we think that green innovation is an important building block in the green transition, and I certainly believe it is, there is a silver lining for Europe, is that Europe is a clear leader in producing green technologies. If you look at patenting in green technology, Europe is actually above the UK, the US, and China. We also find, and there's results in the paper, that green innovation actually generates significant spillovers, including in other technologies. So investing into those green innovation will generate productivity gains, not only for firms that are actually implementing those innovations. So that's really a good news for Europe, and I think, and I think this is what we are doing. We should really structure our innovation policy around those mission-oriented projects, again, betting more on our strength, which is our academic sector. There is still one point of worrying in Europe, is that most of the trend in green innovation is driven by young firms. In fact, if you look at the share of patents that are green or labeled as green worldwide, but that will be true in Europe as well, you can see that the increase started in the end of the 90s, that after the Kyoto Protocol, but it stopped after the great financial crisis. And in a recent paper with Philippe Aguet and co-author, we show that, in fact, this stopped is entirely explained by the tightening of credits that disproportionately impacted young firms. So there is a point of vigilance here that although we are, in Europe producing green innovation at a very efficient rate, this was driven by young firms, and it's very important to ensure that those firms can find the way to finance their risky and new projects into green innovation. So to conclude, in this paper, again, I try to cover 150 years of data. If I would have to summarize very quickly, the past is really much, the post-World War II essentially, is very much explained by a catching up due to the adoption of US technology, low energy price, and investment following World War II. But innovation policy implies that we also missed IT revolution. And I think the lesson for the present is that while we tend to repeat the same mistake as we did at the end of the 80s, I think we should capitalize much more on European strength. And that is good research, good academic research, a large market size, and our leads in green innovation. Thank you very much.
Thank you, Antonin. Kalina, please, the floor is yours. Good job.
Thank you for the opportunity to be part of Sintra this year. Antonin has just given us a wide-sweeping overview of a vast literature, and it's very impressive, the economic and geopolitical context that he provides for the past, present, and future of European productivity. The economics came forward in the presentation, but I do encourage you to see more on geopolitics in the paper. So there's a lot of insightful analysis contained in this brief presentation. For me, as the perennial intrepid optimist, perhaps the most valuable are the policy prescriptions for innovation and some of the optimistic take on technological prospects for the future of Europe. What I would like to do is to actually give a global perspective and a globalization perspective on European productivity. And I'd like to leave you with three messages. First, globalization creates opportunities for growth, but seizing those opportunities requires some prerequisites: firm efficiency, efficient markets, and stable institutions. This is going to echo some of the messages that came from Antonin's presentation. Second, I think we need to be firmly focused on firms. We do care about macroeconomic policy, we care about aggregate outcomes, but at the end of the day, firms are the decision makers, they are the economic agents responding to those policies, so we do need to remember that they're firms and heterogeneous firms acting in a global context. And third, I think it's important to think about policy spillovers. What I mean by that is both the interdependence in the effects across policies, but also the spillover of policies across borders, given that we live in a global world. So in the 20th century, it was very easy to say countries that are more open to trade, as gauged by their share of exports to GDP on the vertical axis, are the ones that are growing faster. In the 21st century, it's all about chips and ships. There's been technological change and trade policy movements that have really transformed the landscape of international trade. We've seen this rise of global value chains and multinational activity, deeper financial labor market integration, and all of this in the face of large asymmetries across countries in terms of market structures and institutions. So I think the two words that really capture the key features of globalization today are interconnectedness and interdependence, with all the positive and perhaps some negative associations that brings. It has triggered intensified policy debates, and yes, global cooperation is under fire today. So as bold and perhaps as off-topic as it might seem to talk about globalization, I think it's actually doubly important to remember why globalization shapes productivity and innovation. So here is a map of the world that the World Bank produced in 2020. This is reflective of data for 2015, which sort of signals that based on their GVC participation and innovation patterns, most of the developing world is still active in limited commodities in orange, high commodities in pink, some manufacturing in light blue, advanced manufacturing and services, China, in darker blue, and North America and Europe being dominant in innovation. But actually, if we think about who the global leaders today are, well, the landscape is changing fast. In the 20th century, we're used to saying, look, it's the West and Western headquarters multinationals innovating in the West, pushing the world frontier and deploying those technologies globally. Well, today we see a lot of pioneers leapfrogging and innovating at the frontier in emerging economies. And here is an example. At the peak of the COVID pandemic in late 2020, Chinese company AutoX introduced the first driverless cars in the streets of San Francisco, beating the American Waymo to the punch. So let me give you an overview of why globalization forces matter for the path of productivity. The fragmentation of production across firm boundaries and country borders can put firms on a steeper growth path. And there's a distinction here to be made between improving performance given firms' own productivity and production processes and actually enabling firms to improve their own productivity through technological upgrading. We know these forces. Access to imported inputs can allow you to lower your production costs and improve your output quality. If you have access to a bigger export market, you can benefit from economies of scale in production. If we think about upgrading your productivity, well, access to export markets is actually going to encourage you to incur the whatever fixed and sunk costs associated with innovation and adoption there are. Import competition might force you to reassess, are you more profitable with innovation or without if you want to remain competitive. There is also active knowledge transfer when you interact with foreign buyers and suppliers, as well as passive spillovers. And here, on the supply side, you're learning about production know-how, you're upping your management practices. On the sales side, you're developing market expertise in distribution and product customization, and you're stepping on the shoulders of giants. You're enabling follow-on innovation. Participating in global value chains also inherently means that you're changing the set of tasks you're retaining in-house. And this reorganization means that there is scope for efficiency gains that will inherently bring with it a reorganization of your occupational and skill composition, perhaps the way you run your management, perhaps the extent to which you can engage in innovation. So what are the challenges to seizing those opportunities? Well, you got to have knowledge of how to participate in the value chain and be at the technology frontier. You have to have the capability to implement any change in-house. And you have to have the right incentives in terms of cost and benefits. So I would link that to firm prerequisites. We need firms that have technological know-how, but also the right management competence and management practices in place. And we need to have stable institutions. We need to have efficient capital, labor, and product markets. We need to have enabling logistics services that are going to lubricate these global production networks. What I'll do next is sort of embrace pointillism and give you an overview of a few projects that I've been involved in that illustrate some of these forces. And I'm going to signal those with a little light bulb that links to a specific paper. And the little European flag tells you the application had something to do with a European data set. So yes, we know that production fragmentation improves firm performance given your own technology. In the context of China, for example, you see firms that are importing more inputs are able to improve their output quality. In the context of domestic fragmentation for Belgium, for example, we see that larger firms are able to transact with more input suppliers and downstream buyers. This allows them to keep their input costs low and increase their profits. What is required for this to happen? Management practices matter. We're used to talking about productivity as a TFP residual, a black box residual from an estimation function. There is a bottom-up approach that says management competence is actually something tangible. There are practices you can implement in the firm that are really going to help. We were able to establish this using Chinese and US data, and you see in both very different countries that better managed firms are able to use higher quality inputs and more complex assembly processes to produce higher quality goods, at the same time as being more efficient in producing these high-quality goods and having superior export performance. On the left-hand side here, you see the systematic variation in average management practices across countries. North America in blue and Europe in orange do come up tops. On the right-hand side, you see evidence from India that management interventions work, and even 8 years after implementing a management consulting intervention, the number of adopted practices remains quite high for both the treated plants and non-treated plants in the treatment firms. So management practices matter. Institutions matter. So when we just take two countries with good and worse institutions, we might say, look, welfare is going to be higher if you have stronger institutions. When we're talking about implementing reforms, in this case, I'm looking at globalization, increasing export access, or increasing import competition pressures, the marginal effects of those kind of interventions can be positive or negative on the overall gains from trade because we live in the world of second best. Empirically, what we saw looking at data for Europe spanning about 20 years ending in 2015 was something quite subtle. Efficient institutions, labor, capital, and product markets actually amplify the productivity gains from import competition, but on the margin, they dampen the extra gains from export expansion. Trade finance matter. There's a lot of evidence documented that access to well-functioning financial systems is tremendously important for firms' ability to export. Entry, expansion into more markets. These effects were particularly strong during episodes of financial crisis. Trade is much more sensitive to drying up of credit than overall production is. It also bounces back faster. And the effects are concentrated on smaller firms and financially more sensitive sectors. What I've currently been thinking about is not just trade finance, but also trade finance insurance. Given the rise of economic, climate, geopolitical risk across the globe, how do we think about that? Well, Bern Union is the organization of private and public trade finance insurers. And looking at that pattern, what you see here in the right figure is a systematic relationship between the share of private insurance in total trade insurance and country risk. So export credit agencies have the mandate to step in when the private sector doesn't cover risky transactions. In practice, we see that that can be quite a valuable instrument. Market competition matters. It's not only the institutions, but also how we think about efficient capital, labor, product markets. So given that we're an interconnected global world, market structures in one country, and of course anything to do with industrial policy and interventions that change that market structure, will have repercussion effects through upstream and downstream sectors locally, but also internationally. So in this particular project, we looked at how the dramatic liberalization in China at the turn of the 21st century increased market entry upstream in China. And this dramatically improved sourcing outcomes for downstream buyers in France and Chile, as this application was, leading to lower input prices, much better firm profits, and considerably higher consumer welfare. So behind the border policies can have international spillovers as well. So this is how globalization changed firm performance given their own productivity. But it can also enable channels of actually changing your own productivity and production practices. So the first thing to note is that when you're reorganizing tasks across firms, it does mean a technological change within each of those firms. And this is currently of interest in the literature. There's evidence this matters both when you think about domestic fragmentation of production as well as global outsourcing. So for example, for the case of China, we see that within firms over time, there's a very well-pronounced firm life cycle. As firms grow bigger, more productive, and more experienced, they are able to span wider segments of the global value chain, and this correlates with higher profits. Not necessarily a higher profit margin, but higher profits overall. Focusing on domestic fragmentation, we're able to study these questions in Brazil, and what you see is that firms that outsource more tasks to domestic suppliers retain in-house relatively more complex tasks that hire more skilled workers. There's an upgrade in the occupation scale and a shift towards managerial involvement. How about innovation? Not just redrawing firm boundaries and changing task composition, but genuinely engaging in R&D activity that pushes the frontier. Well, yes, historically, and to this day, multinationals are the ones advancing the world frontier. They conduct the vast majority of world R&D, and they are responsible for mediating technology across borders. However, multinationals increasingly offshore their R&D operations abroad. They're not just doing this in Western headquarter countries. Here is an example of two leading German car automakers. Mercedes-Benz opened an R&D lab in Seattle, and soon thereafter, BMW opened one in Shanghai. And both of these are engaging cutting-edge stuff. The Seattle one is doing cloud computing. The Shanghai one is doing automotive design and autonomous driving. So in recent work, I'm looking at the innovation activity of German multinational and taking sort of a holistic perspective of how they organize their production and innovation activities across the globe. So what you see is that of patenting multinationals, almost half, 43%, file patents that were invented abroad. The top 5 hubs are the US, Austria, France, Switzerland, and the UK. But China and India are in the top 15, and this figure, each dot is, where there's been innovation by German multinationals. It clearly spans the gamut of GDP per capita across countries. By looking at global patent outcomes, we can also think about the revealed comparative advantage of different countries in different sectors, something that came up in Antonen's presentation as well. We see that Germany is a continued leader in organic chemistry, so pharmaceuticals, energy, transportation. The US is very strong in medical technology, IT, and telecommunication. Switzerland is very strong in precision instruments, medical technology. Multinationals are offshoring both basic and applied innovation. Think of applied as something that improves your production efficiency today and forever. Basic is something that you have no use for it today, but maybe tomorrow it will allow you to be successful at applied innovation. Basic innovation tends to be offshore to rich countries. Applied innovation seems to have cost synergies with production, tends to be offshore to more emerging economies. Finally, innovation happens around the globe. We have seen a dramatic increase in the number of patents filed with the US and the European Patent Office that were invented abroad, in this case, China. This is what you see in the left figure here. What I'd like to highlight is that this could be not just because domestic R&D institutions are not sufficient, but also because these firms are using the granting of a US patent to expand their sales in global markets. So this tends to signal quality, capacity, and contract credibility. So in my last minute, let me leave you with some open questions that will anticipate our discussion. We do need to weigh growth objectives against what I would call growth plus objectives. How we think about inequality, how we think about resilience in terms of stable output and growth, how we think about sustainability in terms of stable institutions, social cohesion, and climate health. And finally, I think we should reassess how we think holistically about joint trade, investment, and innovation policies in light of the rapid technological change that we are experiencing. Thank you.
Thank you, Kalina. Thank you, Kalina. So, Anthony, how do you integrate these more cross-cutting views that Kalina was giving us with your more sectoral focused approach?
I think it's super interesting and definitely very relevant. I do believe that international trade and global value chain is very important in explaining productivity, and definitely agree with you that institution matters a lot. I think something that I find very fascinating with your research is that it's a way to kind of open the black box of what happened when we trade, when we exchange ideas and patents. And I think this is something very important to understand TFP. I don't have detailed comment to give, but I definitely think this is, of course, a very complementary approach. Thank you for the discussion.
Great. So we already have 3 questions. One, yes, first over there, one over there, the second one over there, then I see a bunch of there. So let's get 3 questions first, and then we proceed. So we go first.
Yeah. So if you think about why the United States has become dominant in IT technology, one has to think about Silicon Valley, one has to think about Stanford University, and one has to think about Hewlett-Packard and the role they played. And if you think about those, then Stanford was a private university, Hewlett-Packard was a private company, in a small company, and there were a few other players that arrived there, and some of it was luck perhaps, but I think much of that came from private and a free market in that area, with huge subsidies from the government, no doubt, right? There were research grants given to Stanford University and so forth, so they played a role. But I wonder whether one of the reasons that Europe is lagging behind is that we haven't found the magic juice that they had.
Please, over there, and then.
Yes, Luis Garicano, LSE. A couple of comments. One on the AI. I think it's really premature to try to put numbers on how big AI is. Let me just, on productivity, let me just give you one example. Yesterday's New York Times, the Ukrainians automating robots to fight the war for themselves. I mean, that's going to be a big deal in productivity of soldiers. Second, on the key issue of EU-US, we are, I think, all very worried, and I personally am a bit panicked about this disappearance of European firms from the digital frontier. And I think I read your evidence, which was very interesting, in a different way. I think it's clear what you argue. I mean, to me, what isn't. So you said we should do more public research. Well, public research we seem to be doing, and your data suggests it works out. I mean, the universities actually seem to produce lots of good ideas, and that's where the public research happens in Europe. The second, scale, Leta has emphasized it, we all believe in it, European single market is important. True, but you showed that Japan on high-tech patents is just really doing very well compared to us. They don't have the scale. It seems to me that the problem is not really getting the ideas, it's turning the ideas into commercial products, and that's very much about rules and regulations and firm growth. Let me just give you one example from your slides. From your slides, which was cars. So do you see a European city allowing for self-driving cars in the next 15 years? Like, I mean, with all the lobbies of taxi drivers, of citizens concerned about getting run over. We see that happening in China. We see that happening in the US. Our political process, the way we're regulating all of this is very risk-averse. And we are not being able to actually allow all these ideas and all this innovation to get into commercial. So people just have a good idea and they leave. So those 2 comments. Thank you.
Thank you. Then we get one more question from that side, and then we move on the other side. Please.
Thank you. I'm in the business of prematurely putting numbers on things, and I wondered if I could put you on the spot a little bit in terms of the AI impact. I think the Acemoglu paper says about 1% cumulatively on GDP and TFP over the next decade. If I look at the numbers that you put down in his classification, that gives me something on the order of 4%. But then you say, I think very rightly, that the big boost can come from the creation of new tasks, not just doing existing things more efficiently. And I was just wondering whether you could share a guess with us how much that is worth and what the total might be over the next decade. I know it's super hard to come up with a number, but I would love a number.
Thank you. Antonin and then Kalina, briefly, so that we can get some more questions. Please.
I'm going to be very brief. So I fully agree with the first point on Stanford being a private university and private companies leading the IT wave. If you look at whose firm is responsible for the share of IT patents, IBM, Intel, and Hewlett-Packard are some of them. Hewlett-Packard didn't exist in the 70s, I think. IBM existed, and they grow also a lot because of R&D procurement from the federal government. Even though those are private firms and private university, the government was very helpful into ensuring that they could take the risk into betting in new technologies, and this is what happened, I think. Regarding Luis' comments, I completely agree on AI being premature. This is, I think, the guess we can have right now, and of course we have no idea what AI is going to be in the coming years, and it's possible that every task is going to be replaced by AI, and then you get to almost infinite growth. So we know. In terms of public research and Japan doing well, in fact, something I haven't shown in the presentation is that if you look at those 6 technologies that I showed at the end, and you look at Japan share, the share of Japan is actually completely disappearing. Japan has been completely replaced by China is producing those technologies for probably many reasons that has to do with global value chain and being an innovation hub in this region. So I think there is more than just, scale effects probably do matter for those new technologies. And regarding rules and regulation, again, completely agree with you. I think also our risk aversion in Europe is not something that is completely exogenous. It's something that we collectively decide to create. And it's not so clear that we should immediately decide to do exactly what China is doing. At some point, we need to understand why we decide to have a competition regulation that is so strict about M&A and all those all those regulations that are pushing us to be more careful about implementing new technologies. And then a number on AI impact. Maybe I should ask AI to give me a number. I don't know. I think to actually had if you talk at firms, what they really expect from AI is not to replace. I think most people have understood that AI is not going to replace all workers. What they really expect for AI is to be able to reduce the number of mistakes that they make, improve their efficiency by just pre-selecting a lot of the input that they are using into producing their services. And if you think that AI could be very efficient in doing so, that requires some investment, by the way. I believe that the number could be substantial. So there are some papers that even mention that growth could be infinite with AI, because if AI can generate ID and AI can generate new innovation, then the next technological wave could be discovered by the AI. In that case, the growth rate could be very large. So I'm sorry, I don't have a good number to give you.
Kalina, something on rules, I guess. Huh?
Thank you. If we want evidence-based policy, we should not govern by anecdotes, but let me give you 2 anecdotes that I think are quite representative. One of them is Stanford, where I had the privilege of spending about 8 years. Silicon Valley is special. It is a cluster. It's not just the universities. It's a very highly educated
labor force, reaching immigrants. And there's a lot of evidence that immigrants matter tremendously for the US R&D output. And of course, venture capital is just around the corner. In fact, what I still teach to my undergrads is these amazing outcomes of Stanford GSB, where they have a course bridging together. It's called Entrepreneurship for Global Challenges, okay? And it puts together the entrepreneurs from the business school with some of the tech experts from the science departments. They together come up with projects. There's an internal competition. The top 5 winning bids are then presented to the local venture capitalists. The top 2 get funded, and you have lots of success stories every year. So you need a little ecosystem as a cluster. My second anecdote comes from China. Whenever you go there on a conference, they're going to take you on a factory visit. Back in 2010, it was the tomatoes of the future, where we walked into what was a airplane-sized hangar with layers and layers of water tanks rich in nutrients, and tomatoes growing everywhere you can see, and Boston lettuce growing everywhere you can see. Fast forward, last time I was in China before the pandemic was 2019. We were taken, this was in Shenzhen, one of these AI cars. At the time I was told there were 5 of them. The government was actively supporting them. This was part of the 10,000 Talents program, so there were active packages attracting US and UK, well, sorry, US educated talent, I think also Europe educated talent. And they had a labor force of about 100 on site, all of them with US education, Silicon Valley experience. And they were still keeping an office in Silicon Valley with 2 purposes. The CEO was very upfront about this: more talent poaching and cutting edge. So clearly it's a cluster, and going back to what I concluded with, I think we need to think holistically about policy design. And my second point on AI, I'm by no means an expert, but given that there are some opportunities for growth from globalization, can we harness AI towards that? How can we use AI to solve some of our climate models? And given that there's some challenges to seizing those opportunities, how can we harness AI to relax some of the constraints we're facing? So for example, I've been working on buyer-supplier matching in production networks subject to a lot of contracting frictions and information asymmetry. Can AI be used to optimize some of these processes?
So thank you. I'm sorry, we don't have much time. Actually, we are already over time, so I am closing this section. So the only things I can say, I want to thank our 2 excellent speakers for this brilliant presentation. Thank you. Claire, the floor is yours.
Thank you. This was great.
So I'd like to thank the chairs and the panelists for our 2 opening sessions. I think you both did a great job of really showing how historical trends can really inform how we think about policies today. We'll now take a coffee break for the next half an hour, and then please return after that for a talk on the future of interest rates. Thank you. Hello and welcome back into the room. The equilibrium rate, or R star, is the level at which borrowing costs are consistent with price stability and full employment. Sounds simple, right? But trying to nail down exactly where this Goldilocks rate will lie in the future is anything but. R star evolves over time, depending on factors from productivity growth to demographics to shifts in demand for assets. This panel, made up of experts from central banks and multilateral organizations, will answer where they think R star is heading in the future. It will be chaired by Philip Lane, Executive Board Member of the European Central Bank. Over to you, Mr. Lane.
Okay, good morning, and thanks to Claire for helpfully defining the Goldilocks rate in the introduction, which I do think is a very natural benchmark. But the title of the panel is Drivers of Equilibrium Interest Rates. So it's multiple, maybe. So is it a single interest rate? Does it vary across countries? Do we think about the equilibrium policy rate? Or do we think about the equilibrium margin product of capital, for example? Or do we think about the equilibrium yield curve? So already, let's see how much progress we make in the next 90 minutes. It's also, I think, maybe the panel will get to some of these issues. One version of this is, let's just take an economic perspective. In other words, a real economy perspective. So in a world without any finance or money, you can think about the equilibrium of world savings and investment. However, then you can say, well, still staying in a real setup, add a financial system. Add a financial system that works, but sometimes that doesn't. And when it doesn't work, when there's a broken financial system and intermediation is non-trivial, does that change the interest rate that's needed to deliver the Goldilocks equilibrium? And then, of course, on top of that, you can move from a world where you also add money. And if you add money, it raises the interesting question about nominal factors versus real factors, and whether, in the most intriguing way, you can break the separation between the short-run effects of monetary policy and the long-run equilibrium. So no doubt we'll have delivered sharp conclusions at the end of this, where all of these are settled topics. And this should be a very productive 90 minutes. So with that, you've seen the bios. We have a great set of speakers, and I hope blended across the worlds we live in, between academia, policy organizations, and central banks. And with that, the lineup is alphabetical. So Claudio, over to you.
Well, thank you. Thank you very much, Philip, and thank you for the very kind invitation. I will, however, be probably the proverbial party pooper, in the sense that I'm sure that you have invited me for a reason. And the reason is that I tend to be rather skeptical about our star, and I will not disappoint you. So what is the question that the panel has been asked? Is where will real interest rates go? And in order to answer that question, we're invited to think in terms of where will R star go? Well, my answer, if you like, as that famous joke goes, is that, well, if I were you, I wouldn't start from here. I would not pose the question that way. That's effectively what I will be trying to argue. Because thinking about where real interest rates will go based on R star is probably not particularly helpful. And for much the same reasons as R star, I think, is not a particularly helpful compass for monetary policy. So I'll try to explain that in the time available. By the way, the usual disclosure does apply. I mean, the views that I'll be expressing are my own and not necessarily those of the BIS. I think some distance helps in this context. It will allow me to be a bit more provocative. For the views of the BIS, there is a whole box in the annual economic report that actually discusses our star. Of course, they're not that different, but there are some differences. So let me start. What's the definition of our star? And I think we can converge at least on one. There are many. But that our star is that short-term real interest rate that would prevail when output is at potential, inflation stable over at target, once disturbances in the economy have died out. So in some kind of steady state. Now think of our star, and I will come back to this, as the real interest rate that would prevail when the economy is in a quote-unquote good place. So fundamentally, as we know, our star is an unobservable, model-based concept that refers to a hypothetical state of the world. Now, our star can be a useful guide as to where real interest rates will go, actual real interest rates will go, to the extent that two conditions hold. The first is that over time, the economy is close to steady state, on average, so that the real rates actually reflect our star. And the second is that there is a reliable link between our star and its determinants, so that one can form a view about how our star will evolve in the future. Now, the problem is that on closer examination, empirical evidence does not really support either proposition very much. And the reason is that the evidence that invoked in favor of our star invariably simply assumes that one or both of those propositions hold. That is, it doesn't really provide any independent evidence for them. And this is true regardless of the approach, whether you're thinking in terms of calibration, narrative, or filtering. And we can sort of discuss that later. But the key point is that, in fact, if one allows the data to speak and test directly the link between the so-called the candidate determinants of R star and market interest rates over long periods, well, the evidence suggests that this link is very loose. Now, let me be more precise about this. In BIS work that we did some time ago, and actually that has been, and there is growing evidence that is going that way, including recently a paper by Rogoff. What we do is that we consider a whole set of usual suspects: demographics, growth, price of capital, income distribution, government debt, and variance of real interest rates over long periods and possible proxies for R star, looking at 19 countries. And we find that there is a reasonable, indeed, well, quite a reasonable link over the standard period. That's since the mid-1980s onwards, when real interest rates were declining. Remember, the whole period started with a Volcker shock. But the link actually effectively disappears if you go further back in time and you look at a longer period, going back to the 1890s, and you break the period up in various subphases as well. Now, given this, it's not surprising to see such a heated debate about where R star is and where it's going, given that the factors that explained R star tend to be very slow-moving, and they presumably have changed quite little. Why should the current estimates of R star that are being produced be considerably higher than they were before? And since the evolution of the various candidates could pull in opposite directions, then the effects are so hard to parcel out. I find this is going to be very difficult to tell where interest rates are going to go and where R star is going to go. And I find this a rather sterile debate. You know, in Italian, we have an expression which is, it's a little bit like debating about the gender of angels. And you tell me which gender they have. Now, this brings me to what is probably the more controversial, if this hasn't been controversial, part of my presentation, which is about the link between real interest rates and monetary policy. Now, in contrast to the empirical evidence that I just mentioned concerning the usual suspects, I think there is growing evidence that points to a link between monetary policy and real interest rates over long periods. This is not very short cycles, over long periods that are even abstract from the cycles. Now, for example, in the same exercise that we did in the past, we also checked for the link between real interest rates and monetary policy regimes. And of course, in order to do that, you have to go way back in history and look across regimes. And we go back to the classical gold standard. And we find that the level and even the change of real interest rates over long horizons is systematically linked to the monetary policy regimes, even controlling for the usual suspects. And in addition, I think we have become familiar with recent work that has found a strong link between monetary policy announcements and the behavior of long-term real interest rates over a long period since the 1980s, suggesting that a lot of it is can be driven by monetary policy. Now, what does all this mean? I think that maybe a more promising place to start when assessing the future evolution of real interest rates is the reaction function of the central bank. And now let me sort of dig a little bit into this and unpack this statement. Now, central banks, we know, sets the short-term nominal interest rate, and given that prices tend to be predetermined, sets the real interest rate at any given point in time. And that also means, logically, at all points in time. And this is basically what the Taylor rule tells us. In addition, the central bank provides key guidance about where future interest rates will go and therefore influences the whole yield curve, and we had a debate yesterday on this. Now, in real life and in most models, it is in fact the central bank's role. It is the central bank's role to take the real interest rate to R star. It doesn't just happen spontaneously. So that to the extent that R star has information about the future evolution of real interest rates, it is through the reaction function of the central bank. Now, to underscore this point, when one says that central banks monetary policy cannot set the real interest rate in the long run, the only thing that one can logically say, given what I said before, is that unless the central bank sets the real interest rates at R star, which is seen as independent of policy, something wrong will happen. And it will force the central bank to adjust. Now, in the models, typically in the models that we have, what happens is that inflation either shoots up or shoots down. And therefore, the central bank has to do something about it. Now, I see two problems with these models. That with the end result, I think that they overestimate the extent to which R star imposes a constraint on monetary policy. The first one is that in practice, the link between the short-term real interest rate and output at potential and stable inflation is quite imprecise. So that there is a kind of range of interest rates that can roughly be consistent with those outcomes. So it's more like a thick correspondence as opposed to a precise function. Too many factors simply come in between, even over extended periods. And this may indeed be one reason why estimates of R star that rely on these relationships have such large confidence bands. So, in a way, it is not that we are measuring a precise relationship imprecisely, but that the relationship itself is quite imprecise. So that it's not surprising that at any given point in time we have such big debates about whether interest rates are above, below, or at R star. Now, the second problem, and this is more subtle, is that the behavior of inflation may not be a sufficient statistic to take the central bank to a good place. That is, not a sufficient statistic for a safe journey. And in turn, this will have an impact on real interest rates over very long periods. Now, let me give you a couple of examples of what I have in mind, which I discussed at length in previous work. The first one is what happened before the great financial crisis, when I would argue that the conjunction of secular disinflationary pressures, linked in particular to globalization and liberalized financial markets, meant that focusing exclusively on low and stable inflation led central banks, inadvertently, to accommodate the buildup of financial imbalances that then led to the great financial crisis, which in turn was a major reason for the low for long that we saw afterwards. So, let me stress, I'm not saying that monetary policy was the main factor, or indeed the only factor. By any means, many other factors were more important. But I do think that monetary policy did contribute to that outcome. Second case, what happened following the great financial crisis? When even once the economies recovered, the same disinflationary forces and the fact that inflation was evolving in a low inflation regime in which it is less responsive to changes in monetary policy meant that as central banks were so hard trying to push inflation up to target and they were not finding it easy, they ended up losing as opposed to gaining room for policy maneuver. So the idea there is inflation is not particularly responsive. The only way that you think you can gain room for maneuver, that is raise nominal interest rates persistently, is by raising inflation. But if in the process you actually do not succeed in raising inflation, you will be reducing interest rates. So you're effectively trading off a reduction in interest rate now, a loss in room for policy maneuver now, in the expectation that you will gain in the future. Now, and to conclude, does this mean that monetary policy influences R-star? Well, I think this depends very much on, it's a question of definition, it's a question of interpretation. But what I do think it means is that for all intents and purposes, the impact of monetary policy on real interest rates can be very long-lasting and can be hardly distinguishable from an impact on R-star, given the way that we measure it. And it means that focusing on the central bank's reaction function as a starting point may be a better way of trying to work out where real interest rates will be going into the future. So to conclude, when trying to work out where real interest rates might go in the future, I would not try to read it from the stars. I would probably first look at who actually sets the real interest rates at all points in time and what that institution responds to. Because at the end of the day, I think that R-star, very much like beauty, I think it's in the eyes of the beholder. So okay. Thank you.
Thank you, Claudio. And next up is Federica.
Yep. Okay.
It's coming.
Okay, can you hear me? Yes. Okay, thank you very much for having me here. The usual disclaimer applied, because there is one person from the central bank that will help us to write this project. So why we are here today? We are here to discuss about R-star, right? What is R-star? Is the interest rate that ensures that the output is as its target, and also inflation is as its target. Now, one of the main determinants of little R-star is capital R-star. That is the long-run little R-star, but also the interest rate that equilibrates the asset market in the long run. Why we are here to give you this, provide you this framework to understand R-star? Because we want to inform the policymaker so that they can play or they can do their policy informed by our variable, our number on R-star. All this reasoning is based on what? On the standard dichotomy. So we think that in the long run, R-star is determined by the real variable, by the real sector, right? And that the monetary policy cannot do anything to select R-star or to define R-star. But what we're going to do in the next minutes is actually to challenge this view. And I think there wouldn't be a better introduction than the one of Claudio. So let's start with the basic. What is R-star, right? Just to understand what is going on. So R-star is the equilibrium, capital R-star, is the equilibrium between demand and supply of asset. Demand of asset is positive slope, right? And this is made by the household. So the higher is the interest rate, the more asset you want to demand. And supply of asset is negative slope, and is mainly made by corporate sector and by the government. So the higher is the interest rate, the less asset this agent want to issue. Now the equilibrium between these two lines, yes, is actually R-star, right, when they intersect. Now in the last 20 years, we do observe that R-star has been very low for different reasons. Some people say this is demographic, so a shift in the demand curve. Some other people argue that it's low productivity growth, so a shift in the supply curve. We should agree that in this framework, if we want to boost or increase R-star, one possibility is to shift upward the supply curve, so to move from point A to point B. And one possibility is to increase the debt of the corporate sector, right? If the corporate sector issue more debt, this is going to shift the supply, and we're going to have a higher R-star. Now, if we look at the data, we found that this is true before 2007. So here, is debt issuance of big firm, and we regressed this on R-star, and we took the measure from Marco Del Negro and co-author, and we found that before 2007, when firm issue more debt, R star was actually increasing. Now, when we look after 2007, we found exactly the opposite. Whenever the corporate sector will issue more debt, R star was actually decreasing. And this is consistent with all the measures of R star. We took also the one of John and Coder. So this is very puzzling, first of all, because we have different effects, but also because in the standard model, we cannot think that when the firm issue more debt, actually R star is decreasing. So how can we rationalize this puzzle? What we did with quite a lot of Coder, we wrote a paper that is forthcoming now, hopefully, that is monopsony, income risk, and R star multiplicity. So what is our framework? What is our novelty in the standard framework? Let's assume the firm can issue more debt. We have the standard framework that is, okay, they issue more debt, there is greater supply of assets, right? Better insurance for the household, and this means that R star is increasing. Then we have a second mechanism. When firms issue more debt, they can grow larger, they can become bigger, and they can use more the monopsonistic powers vis-a-vis to the worker. This means that workers are going to face lower wage in some state of the world. And this means that workers are going to actually have an increase in their income risk. And so in certain state of the world, you can observe that debt is increasing and R star is actually decreasing through this second mechanism. Let's explain this in a standard graph. We are economists. We like supply and demand. So this is demand of asset. Actually, let me say something. We are going to use now debt instead of asset because in the model, the only asset is the debt. But if we add the instrument, things are going to carry through. Okay? So we start from point A, where there is a certain equilibrium, where R star is equal to R star. And now in a standard model, if firm issue more debt, what is going to happen is that you're going to move from point A to point B. So R star is going to increase. In our model, what happened is that now firms grow larger. They can decrease the wage of the worker using their monopsonistic power. And this means that these workers are going to face lower wage in some state of the world. So they're going to demand for more asset. So we're not going to move from point A to point B, but from point A to point C. Let's do this a second time, right? We're in point C, some firm issue more debt. You're going to move from point C to point E in a standard model. In our model, this is like trigger this second mechanism of monopsony. And what is going to happen is that the firm can grow larger and decrease the wage of certain workers in certain state of the world. The income risk is going to increase, and they're going to demand for more asset. So now we can envelope all these equilibrium points. And what is going to happen is that the demand for asset is going to change. And let's zoom on the demand and explain a bit more. So what is going to happen is that the demand for asset in certain areas is positive slope if the insurance motive is going to prevail. And in some other areas, instead, is negative slope if the income risk is going to prevail. Now, why is important? Because now what we do, we plot again the supply, and voila, we don't have any more one equilibrium point, but we can have two stable equilibrium points. And this means that what we're going to have state of the world in which we are in point A and state of the world in which we're in point B. We think that like point A is a point in which the interest rate is relatively high, and there is like low monopsonistic power from the firm and low consumption risk. And this is very much maybe what happened pre-2007 when we observed that when the firm were issuing more debt, the interest rate was increasing. And then there is a second point, that is point B, where the interest rate is low, there's going to be more monopsonistic power from the firm. The firm are going to issue more debt, but they're also going to increase consumption risk. Now, the problem is that how we're going to go from equilibrium, from one equilibrium to the other, right? So in the steady state, in the long run, they both coexist. You may think that cyclical policy can select one of the equilibrium. Also that since we are in Sintra, we decide also to speak about monetary policy that can actually select one of the two equilibria. So is it possible that monetary policy can select an equilibrium in the long run? Now, in our framework, the answer is yes. So what we look at asset purchase program. And in this case, what is going to happen in the model, that even if the household is buying zero of this asset, then the central bank is directly or indirectly buying the asset on behalf of the household. And this is going to trigger the income risk channel. So the firms are going to grow larger, maybe, and then they're going to squeeze the surplus of the worker in certain state of the work. So what is going to happen here, if we play this policy, The equilibrium A, where the interest rate is high and there is low consumption risk, is going to disappear, and the central bank is going to select the equilibrium at point C. And in some sense, this is like, in our framework, what is going to happen is asset purchase may select the equilibrium with high consumption risk and low R star. And this is also in line with a recent statement from Isabel Schnabel that say that it could be that this asset purchase may have a long-run effect that we didn't think about, right? So let me conclude. So we may think that we start by saying that what was our job in this panel is that we're going to give you a number, we're going to give forecast so that you can play your policy or you can choose your policy optimally. However, if the framework that I'm describing is the right one, it's going to be very difficult because R star will depend on the policy and the policy will depend on R star. And this is due to the fact that our framework featured this multiple city state. Let me say that we're not the first one. Stephanie has a wonderful paper with multiple city state and also breaks the classical dichotomy. And Claudio, among the others, among also Luca, there are some people that were saying a long time that maybe the classical dichotomy is not there anymore. Now, this means that cyclical shock, but also policy, can select the long-run equilibrium. And in some sense, this also means that policymakers have an extra and great power that they can play. They can affect not only the short run, but also the long-run equilibrium. However, this means that we need to have more research on this issue, and we need to understand deeply if this is the case, especially because, as a very wise and old man said, with great power comes great responsibility. Thank you.
Thank you. Okay, Stephanie, you're next.
Okay, it's a great honor and pleasure to be here. So I will report on R star, and this is based on a joint paper with Martin Uribe on the macroeconomic consequences of natural rate shocks. So the definition of R star that I will use in my remarks is as the permanent component of the real short-term interest rate. That is the definition that was first offered in the seminal work of Laubach and Williams. And my empirical work is not the same as theirs, but similar. So why should a central bank care about R star? What's the meaning for them? And R star, defined in that way, is relevant because it refers to the real interest rate that obtains in the absence of any cyclical shocks. And in that state of the world, you would say that the nominal interest rate that the central bank sets should be equal to the sum of R star and the inflation target. So suppose the inflation target is 2%, and we came to determine that R star is 1%, then it would say that the interest rate that the central bank should set is 3%, or in the jargon of the profession would be that the neutral nominal short-term rate would be 3%. So that's the importance of R star. There is a large literature on estimating the path of R star. We also do this. We look, as many other people here in the audience have also done, on long data. Why might you be tempted to think it is interesting to go back in time and look at data, in our case, since 1900, is because for a long time we thought the world is the great moderation. There are very small fluctuations in inflation and output only, but this idea that we live in the great moderation has, I don't want to say disappeared, but you might reconsider that idea because of the big fluctuations we have seen in the 2008 financial crisis and then in COVID. So that's the motivation why we look at long data. And what this graph shows you with a solid line is the point estimate of R star since 1900. And I want you to remember maybe, well, I'm going to make 4 comments on it, but maybe I want you to remember only one point, the one I'm going to stress the most. This is not a horizontal line from 1900 until 1985 and then declining, but this is what we call a super cycle. There have been some swings. So maybe the previous super cycle began before our sample, before 1900, and then R star has, with lots of uncertainty, I admit that, been drifting down. And the trough of that cycle occurred at an important point in economic history, namely in 1933 at the end of the global financial crisis. And then generously I looked through some of the bumps and I would say in that trough in 1933, a new cycle began that reached a peak in the early 1980s or mid-1980s, and from this point we started again a decline in R star. And so that's the first thing I want you to keep in mind. There's a super cycle. The declines in R star that we have seen since the mid-1980s are not new. In the history, we have seen that before. So we are not in completely uncharted territory. The second point I would like you to see in this graph, and that is something that has also been emphasized by papers of the speaker that will follow me, is that of the 2 percentage point decrease in R star since the 1980s until now, about 1 percentage point occurred during the financial crisis of 2008. So big declines of R star in the financial crisis. My sample has 2 financial crises, 2008 and also 1929 to 1933. I don't want to take this literally, that it fell so much, but I see that at least in the 2 financial crises in my sample, there was a big decline in R star. That gives me some pointers of where I think theory will help me to understand what moves R star. And so I'm going to latch on to this observation that it fell a lot in the 2 financial crises. And then just a quick answer to a talk of Isabel, is R star rising? At least in this way of estimating R star, which might not be the definition you have in mind. There is maybe a pause, maybe we are at trough right now and we're going to start a new upward slope, but we can't say. We haven't seen it rising yet, it seems to be flat. So from this super cycle pattern, one might say, okay, we always hear that demographic considerations could be a potentially compelling explanation of movements in R star. And those demographic considerations that are mentioned are typically linked to ideas such as a decline in the population growth rate or in aging of the population. That means how many economically active people you have relative to the retired people. So if you look at data, at least in the United States, there's a monotonically increasing share of economically inactive people, or population aging has increased monotonically since 1900. So if you want to say that these super cycles that this graph suggests is driven by demographic consideration, that's at least inconsistent. So that makes you think not of demographic reasons. So the second, one of the things we do in our empirical work is to ask what are the drivers of R star. So we have an econometric model in which we can ask what happens if there's a shock that lowers R star by 1 percentage point, what happens to endogenous variables. So I brought you one of those pictures, namely what happens to real GDP per capita. And what this figure tells you, if there's a shock that lowers R star by 1 percentage point, then it lowers the level of real GDP per capita in the long run about 7 percentage points. So I didn't dare to bring 3 figures, but to think about what this impulse response means, if you see these plots of the level of real GDP per capita is a parallel downward shift. So I'm not talking about a change in the growth rate here. I'm getting a downward parallel shift in the level of real GDP per capita. Why is it interesting to show you that picture? Because I will have to come up, or it helps me to talk about what are theories that might be able to be consistent with a decline in the real rate of interest and a negative level effect on output. And that is why I put initially my finger on that. In my sample, I have 2 financial crises. In both of these financial crises, R star fell. And I'm going to claim that this can be made consistent with this observation that there was a downward parallel shift in the level of output. And it's going to go very much in the direction, perhaps, what Federica gave, because the idea is, suppose you have liquidity frictions in the economy. We all know that the strength of liquidity frictions determines the value of a short-term asset might be the interest rate it pays you. That is what my R star would measure. But it also has a shadow value, namely how useful that particular asset is, say, in posting collateral, how much collateral you can get to that, and that is not incorporated in the interest rate. That's a shadow value. So the higher is the shadow value of the asset, the lower is R star. But that means when R star is low, it also means the financial constraint should be more binding or should be tighter. And these are moments, if this is a financial constraint on investment of the economy, for example, it also will mean that the level of investment, not the balanced growth part, but the level of investment will be lower. So it will lead to this joint observation that you have that a negative shock to R star, which would mean a financial tightening, is associated with a negative effect on the level of output. And that is what this impulse response suggests. Since I have 60, no, I'll leave it here. So that's what I wanted to say.
Very good, Stephanie, thank you. So the final speaker in the first round is John.
It's great to be here in this panel on this topic that obviously I've spent a lot of time in my career thinking about. So for over 125 years, and I can back this up with data, for over 125 years, economists have grappled with a dilemma. So how can a concept that's just at the very heart of monetary theory be so vexing to quantify? Now, so of course I'm talking about R star, the natural rate of interest, and these quotations I have in Table 1 reflect the age-old challenges surrounding the measurement of R star and the importance of R star. And if you go back to Cassell, my namesake John H. Williams, who has, I think, the best quote on R star of all time. And then, importantly, Milton Friedman's presidential address talks about the natural rate of interest as well. And then, you know, when Thomas Laubach and I wrote about this a little over 20 years ago, we emphasized, again, the time variation in the natural rate of interest, as well as the significant uncertainty about that. And of course, today we're seeing the same discussions happening once again. So my comments will very clearly focus on longer run R star, which is the real rate expected to prevail when shocks to the economy have receded and the economy is growing at its potential rate. Before I go any further, I have to give the standard Fed disclaimer that everything I say reflects my own views and not necessarily those of the Federal Open Market Committee or anyone else in the Federal Reserve System. Well, Milton Friedman, in his essay, said that we didn't really have ways to estimate natural rates back in 1968. But since he made that claim, there are now a number of common approaches to inferring R star from the data. One is to use statistical methods to extract a longer run trend. The second is to base it on financial market or survey data. And the third is to look at R star's effects on economic data. And I think each one of these is useful, provides valuable information to researchers and others, but they each also pose significant challenges, which has already been discussed. So back in one of my papers with Thomas Laubach, we did look at some of these other methods, and we emphasized or argued that univariate statistical methods do not adequately control for economic effects factors influence interest rates, and therefore these estimates can be overly influenced by large macroeconomic disturbances. Think back of the inflation of the 70s or the pandemic. Financial market and survey data are subject to mismeasurement issues, and in any case tell us what people are talking about R-star, or how they're thinking about it, rather than acting as an independent source of information on R-star. It's what I called several years ago the Hall of Mirrors effect. So for these reasons, I'm going to focus on estimates of R-star that come from macro models that do not rely on financial market or survey data. And of course, and picking from the wide range of models I chose the Halson-Laubach-Williams model. And that infers the natural rate of interest through the behavior of interest rates, inflation, and GDP, or as the economist John H. Williams put it, by its works. Our estimates of R-star in the euro area in the United States fell dramatically over the quarter century leading up to the pandemic, and they're currently near the estimates that we obtained directly prior to the pandemic. So figure 1 here shows the time series of our R-star estimates for the euro area in gold and in the United States. So I'm going to focus here on the euro area given our location. The estimate of R-star in the euro area was 0.5% in 2023. That's equal to its average of the 5 years prior to the outbreak of COVID. And this estimate this assessment is of a very low R-star is broadly consistent with the analysis done by ECB economists using a variety of methods. The sizable decline in estimates of R-star during the decades prior to the pandemic is common to many advanced and emerging economies. It reflects developments related to the global supply and demand for savings. And it sounds like that's the one thing we all agree about. But the literature has highlighted falling birth rates and relatively low productivity growth have reduced the demand for savings over time. And of course, increases in longevity and wealth inequality have been identified as potential reasons for an increase in supply of savings. I would emphasize the word global, because in a world of open capital markets, one would expect that R-star to be highly correlated, if not in fact the same, across countries. In fact, in our paper with Catherine Holson and Thomas Laubach in 2017, we showed that there is evidence that R-star estimates across countries are highly interconnected, although local factors do also play a role. Now, the role of common and idiosyncratic factors is seen by comparing estimates for the euro area to those in the United States, as you see in the figure. Although the two sets of estimates display some shorter-term wiggles, the dominant shared feature is a substantial, sustained 2 percentage point decline in R-star over the past 30 years. We see the same pattern in our model estimates for Canada. According to these estimates, the low R-star regime endures. This finding runs counter to recent commentary suggesting that R-star has risen due to persistent changes in the balance between the supply and demand for savings, such as higher investment in AI and renewable energy, as well as larger government debt. In fact, some measures of longer-run R-star have, in fact, risen to levels well above those that we saw directly prior to the pandemic. In particular, or for example, market-based measures of five-year forward real rates for the euro area in the United States have risen well above the HLW estimates, as shown in this figure. So up in the upper panel is the euro estimates. The blue lines are the HLW model estimates. The gold lines are taken from forward real rates in the lower panels for the U.S. So two things stand out from this figure, and there's a lot of estimates of R-star. Matter of fact, most estimates of R-star use data either from financial markets or surveys. So, when you look at what's going on in financial markets, it helps you think about some of these estimates of R-star. So two things stand out. First, until recently, the far forward real rates displayed a broadly similar pattern of decline as we saw in the model estimates of R-star. So there's a lot of, before the pandemic, these things tended to move together and tell the same story. Hence, I think, a pretty broad consensus that natural rates had declined significantly in the decades prior to the pandemic. But the second point I would make is that market-based measures can be quite volatile. Indeed, in the years before the recent rise, they had fallen to very low levels, quite negative, in both the US and the euro area, and well below the corresponding model estimates. In looking at this more closely, there's evidence of significant time-varying risk premia in bond yields, and that interferes with taking the market-based measures at face value and assessing what markets are telling us about perceptions of R star. For example, if we, based on D'Amico, Kim, and Wei term structure model for the US, the estimated rise in the US far forward expected real yields since the onset of the pandemic is significantly smaller than that implied by the direct real read of real yields from TIPS markets. So where does that leave us regarding R star? Although the value of R star is highly uncertain, which was emphasized from 125 years ago, emphasized in my paper with Thomas Laubach in 2003, I would argue that the case for a sizable increase in R star has yet to meet two important tests. First, owing to the interconnectedness of R star across countries, plausible factors pushing up R star on a sustained basis are likely to be global in nature. This highlights a tension between the evidence from Europe that R star is still low and arguments in the United States that R star is now closer to levels seen around 20 years ago. Second, any increase in R star must overcome the forces that have been pushing it down for decades. In this regard, recent data reinforce a continuation of pre-pandemic trends in global demographics and productivity growth, along with some of the other drivers of R star. One lens through which to see this is our model's estimates of potential GDP, or what we very creatively called Y star. Potential growth rate of Y star is a key factor in our model that affects R star in many theories. So many of the explanations arguing for a higher R star today would likely show up in higher potential output growth as well. However, the HLW estimates of Euro area and US trend potential GDP, or the trend growth in Y star, today in 2023 are nearly unchanged from their respective 2019 values. And this is consistent with other estimates of potential GDP growth for the Euro area in the United States. So we're not seeing evidence of a significant shift in the trend growth rates of the economies or in our estimates of R star. So let me end with a brief comment on the usefulness of estimates of R star for policymaking. First, as Swedish economists Knut Wicksell and others have stressed, R star is either explicitly or implicitly at the core of any macroeconomic model or monetary framework that one can imagine. Pretending it doesn't exist or wishing it away doesn't change that fact. In that context, it is important that we do our best to understand the factors that affect R star and the uncertainties related to it, so that we have the best possible understanding of the forces affecting the long-term evolution of our economies. And second, and equally importantly, as shown in my work with Athanasios Orphanides, the high degree of uncertainty about R star means that one should not overly rely on estimates of R star in determining the appropriate setting of monetary policy at a given point in time. Instead, such determinations must be, and are, based on a wide range of information and assessments, including those related to risks. Thank you.
So I think there's commonalities across the four presentations, but of course there's also different areas of emphasis. But before turning it back to the panelists, we've also essentially heard a lot about R star across many of the sessions across the last 2 days. And indeed, in the title of the event, in terms of an era of transformation, maybe I'm going to ask each panelist just see if they have any responses to what they've heard. But maybe I'll have an overlay question, which is essentially, in a world of uncertainty, there are different ways uncertainty can affect R star. But let me interconnect with monetary policy. So how monetary policy is conducted under uncertainty. Do you have a sense in either direction? In other words, if monetary policy supports economic recovery, does that raise or lower R star in the future? Or equally, if monetary policy is insufficiently supportive, do you get into a trap where the economy fails to recover and R star might be lower for that reason, which I think part of your previous work with Gianluca and others or people had that flavor. But anyway, we'll go in order. So if you want to pick up anything of what you've heard, Claudio, over the 2 days or over the panel.
So let me actually start from the last remark that John made, with which I fully agree. And it's the fact that in a context in which R star is so hard to pin down, you would like to have a monetary policy strategy which reduces the weight that it assigns to it. So to me, you will find out where R star is if you want to use it at the core of your framework when you get there. And how do you know when you get there? Well, basically, you will be in a situation in which, roughly speaking, if inflation is doing fine. But I would also add to that, not only that inflation is fine, you've got low unemployment and the like, but I would also add, for what I said earlier about a more complete definition of equilibrium over time, that you're also in a situation in which those symptoms are there, but also you don't have the sense that there is a buildup of some kind of imbalance in the economy, including financial imbalances. So I think that a richer definition of an equilibrium real interest rate would include not just inflation, not just potential output, but would include what's happening on the financial side, because that can have big implications for potential output, for actual output, and for inflation down the road, as we saw, for example, in Stephanie's own work and even John's work. When you have a financial crisis, that actually does tend to reduce the equilibrium real interest rate in some sense in the economy. That's basically my main point. For example, now we have a situation in which, as we mentioned, we heard yesterday, there's still possible upside risks to inflation. Those that I would stress are those that are related to the fact that we've got these two relative prices that haven't quite adjusted, services versus goods, core goods, and real wages. And of course, the two are very closely linked because services are very labor intensive. And you also have a situation in which ideally you would not like to go back to the previous world in which you basically run out of monetary policy room for maneuver at a time when fiscal policy has effectively run out of room for maneuver. If you have another recession down the road, it's going to be very difficult for fiscal policy to act, given that fiscal positions are already on unsustainable trajectories. And you would definitely like to have some room for maneuver in monetary policy to react. So I think based on this, my suggestion is, well, let's try and go slow with the ease, and at least not rush to ease on the assumption that real interest rates, equilibrium real interest rates, have to be as low as they were, or we thought they were, before the inflation surge.
Thank you. Federica?
Okay, so first of all, thank you very much for the question. So I think there are different things to think, right? I think Ricardo Reich is in the audience that speak about R star or M star, right? And there are two different variables. So there is the marginal product of capital that I think behave very differently with respect to R star. So it's also different. I think like the central bank can affect these two measures maybe in a different way. So we see R star that is collapsing, but we see the marginal product of capital that is actually flat over time. So it's very difficult to understand. If you want to stimulate the corporate sector, then maybe we should affect M star and not R star, or vice versa. I agree with Claudio that, in part, like if I think about our framework, is the fiscal policy can do something, but now the space for the fiscal policy is very much, so the fiscal policy doesn't have a lot of space. However, I do believe in part that I do believe that there are these multiple city states, and what happens is that in some sense, if the monetary policy does the right thing, it can also have a very fast recovery, because if you are switching the equilibrium and you're going to like a much higher R star maybe, then there will not be the need anymore to have this zero lower bound on all these constraint problems. And I think in part the fact that we were thinking that R star was low and we were playing all this unconventional policy in order to stimulate the economy could be part of the problem for the reason why R star was actually so low. So in some sense, I think I'm very positive. I think the central bank can do a lot of things here.
Okay, very good. Stephanie?
Yeah, so can monetary policy affect R star? again, that depends a little bit on the definition. I would say that in the most commonly used conceptual framework of monetary policy making, it is assumed that the key friction is a rigidity in nominal prices or nominal wages. And then the idea is to bring about an equilibrium via monetary policies so that the economy looks as if we had undone this friction, so as if prices are flexible and wages are flexible. And that is, for a policymaker, of course, the most relevant measure maybe of the short-term equilibrium interest rate, and that might be quite different from what I have been calling our star. And so I think there, on this gap, the monetary policy maker has a lot of power because they can close that interest rate gap in the short run. Now, thinking about the really long run, is it true that monetary policy can influence what the real short-term interest rate is, absent any cyclical variations? I have more reservations. I think simple plots in introductory economic textbooks about the relationship between the nominal interest rate and inflation sort of support that there is a long-run Fisher effect. I'm not talking about neo-Fisherianism, just a long-run Fisher effect, which means that it is very difficult to find empirical support for the assumption that monetary policy affects real rates in the long run. In fact, we started out in this paper trying to see if we could find something along these ways, and doesn't mean it doesn't exist, but we tried it a little bit and we came up empty-handed. So I would say in the really long run, I think I have not seen evidence that overturns the long-run Fisher effect.
Very good. John?
Well, I agree with what Stephanie was saying, and I think on this multiple steady states, multiple equilibrium models, which there have been different versions of these for decades now, and I think it's really, at least from my perspective, it's really important to say that these are multiple equilibria in terms of real allocations. So the levels of output and things like that. And so, I feel like they're getting kind of pulled into this multiple R star because R star is kind of an interesting thing to talk about in that way. But they are models that tell you there's multiple steady states, which are interesting. I think getting back to the evidence about this and the transition, I think deserves a lot more study. And, when Stephanie and Martine and Jess did their work with multiple equilibria with the zero lower bound, the perils of the Taylor rule, I mean, a lot of people studied this very carefully, including my work with Thomas Mertens, because it's a profound insight into the fact that you're going to have multiple equilibria. But they, at least in our paper, when we studied the implications of that theory, which is completely, we showed exactly the same thing you all showed theoretically, we found the empirical implications of that kind of liquidity trap equilibrium were not supported by the data. So I think, I'm very interested in kind of models that have multiple equilibria, making sure we understand that. But I just think we should definitely, as you did, Stephanie, look for the evidence carefully about the relationship between actually short-term monetary policy and kind of a long-run concept like R-star. Just one sentence on this. As a policymaker, I think the most important thing we do in terms of affecting the long-run variables of the economy, one is that we eliminate the uncertainty about what inflation will be in the long run, so pi star, if you will. And we've done that in central banking around the world throughout over the past few decades, and especially during the pandemic, that we take that uncertainty out and do the best that we are able to stabilize inflation and stabilize the economy. That reduces macro uncertainty. You can't get rid of all of it because there's a irreducible uncertainty in any economy. But to the extent that we can reduce uncertainty and we can and have people have confidence about the inflation target, I think that may affect actually real outcomes in the long run.
Very good. So I think we have time for questions and comments from the floor. I'm a very left-handed person, and I'm aware the left side of the room has not been overrepresented so far. So I'm going to go in sections, but I will favor the left hand, my left hand, and Alan Blinder.
This is a Hamlet and the Prince of Denmark question. John and others raised quite correctly things that you might expect to affect the balance of saving and investment and therefore the natural rate. Why does not anybody look at data on savings and investment?
That's what we did.
Very, very good. So again, from the left panel, because I'm not coming back to you. So the left side of the room, is there anyone else? Okay, I'll move to the center. Isabel, and then Klaus, please. So please, in the front row here.
Thank you very much. So absolutely fascinating panel. I have more of a comment, mostly on what John said. So, I mean, there is, of course, not necessarily a contradiction between the fact that some of the factors that have been pushing down our star are still present, and that still our star may move up. And I mean, we've seen this historically, that kind of at times of transformations, I mean, we've seen these deviations from the long-run downward trend. And so the question is, and I think it's an open question because, I mean, you don't see it in some of your estimates, but the question is, are we not again in such an era of transformation where actually several things are happening that could lead to one of those deviations from this kind of more downward trend? And of course, I mean, the green transformation comes to mind, I mean, the AI revolution. And I mean, all of those transformations let us expect that there should be, I mean, globally, an investment boom, which is almost unavoidable. If you think about climate change, I mean, it's not just about the climate transition. It's also about, I mean, adaptation. Or if we don't do anything, I mean, it's about just repair. So wouldn't that mean that we could expect that our star should move up, even maybe at some point it may go back to that negative trend?
Thank you. And next, Klaus in the back row.
Thank you for taking the question. So looking at the historical estimates of our star, there are two things that stick out. One is the downward trend since the 70s, but there's also this episode around the great financial crisis 2007-8, where suddenly the estimates tank and they don't recover, and they don't recover even though the real economy has recovered. So now there are alternative interpretations one can give to that. One is along the lines of Federica that says we have entered a new regime and we are in a new steady state, and maybe there's some multiplicity in the steady state value. There's an alternative interpretation is that something happened prior to that that sort of masked the decline and then suddenly it materialized during the crisis. So I would like to hear the committee's view on which of these is more plausible, maybe.
Okay, thank you, Klaus. And I'll just take Beat and then turn back to the panel. So in the second row here.
Thank you very much. I certainly feel that the concept of R-star has had quite a career over the last career jump over the last year or so, maybe as a result of inflation being a bit stickier and growth being more resilient. But then, so my question would be, you know, whether when we talk here about R-star, would you just say, well, you know, there's short-term, there's long-term R-star, and really what is happening right now doesn't affect your overall sense? Or have you, you know, over the last year or so, maybe changed the way you look at this concept? Has it influenced how you would assess it currently? Thank you.
Okay, so I'll ask each of the panelists to take up whatever they want to pick up from those questions. So, Claudio?
Well, on the financial crisis, again, that depends very much on also on the type of model that you have in your mind. I can sort of write models in which effectively R-star is not even unique in terms of multiple equilibrium, and more to the point that depending on the real interest rate that you have, you're going to have economic fluctuations that are quite different. It's quite clear that once you have a financial crisis, interest rates will have to fall in order to help balance sheet repair, in order to help the economy to recover. And then the question is, what led to the financial crisis? What are the factors that led to the crisis to start with? And whether those factors can somehow be related to R-star. Again, I think that these discussions are very unlikely to find a sort of a clear answer that is going to be particularly helpful at the end of the day for policy. But let me stop there. I mean, I could take the other.
Well, I think Alan Blinder. Quest about saving, because you've worked on this.
Yes, I mean, obviously, you might be able to use saving and investment. In equilibrium, saving and investment must be the same. So you have either use exogenous variables that are supposed to be linked to saving and investment in order to see what's happening to and correlate those with real interest rates. Or you might do it across countries, but even across countries, we know that for the world as a whole, saving and investment exposed must be the same. Now, what I think is very important is that whenever one tries to link the presumed determinants of equilibrium real interest rates and the real interest rates over long periods and various measures of those, it's very difficult to find a stable relationship over time. And I think that's key when one is thinking, because that is the basis for which that people use in order to say our star has gone up or has gone down. But actually, empirically, the relationship is very, very loose.
Thank you, Federica.
I will start from Klaus and then I will move. So let me double down to what you say. After 2008, I think there are other things that happen in the market that were very strange. So if you look at, there is a paper by Perry and some co-authors that say the equity market boom like crazy and then it starts to increase. Then there is like some paper that showed monopsony actually is increasing also. And in the meantime, I think Caballero, Gurinchas, and Farid show that marginal product of capital stay constant and our stars start to decline. So in some sense, and it's a very strange trend because if you look at the data after 2007, like 2008, all these variables start to change in a very strange way. So this is the reason why I was thinking to multiple regime, right? That we're like moving from one to the other. There could be different explanations, but so far it's like I think it's difficult to say that we were like in the same regime like we were before 2008, 2007. Now, to go back to Isabel instead, I think exactly. So if we move so fast, if there was if you look all the data and the trend, like after 2007, our star was declining, and in different series. I mean, I'm not a data person, but I look at all the series. It seems that there is a big change, right? So it also could be that in the future we're going to have a big spike. I don't see why this shouldn't be the case. And it's true that we can have something like that is moving in the opposite direction. Maybe I'm wrong about the multiple city state. I don't think I'm wrong, but it's I think we should understand what happened exactly during that year and what it changed in the market. And if we keep thinking that everything was exactly equal before 2007, we're making a sort of mistake. And going back to, I think, investment and saving, I think one can use investment and saving, but then if you look at investment, I think then the return is the marginal product of capital. And going back to the point, I think marginal product of capital is if they don't use this, if in the estimation they don't put the return on bonds, then the marginal product of capital has been flat. And it seems that there is a huge, so in some sense there it doesn't seem to be any puzzle because it's exactly what we have from the data. So did I reply to all the questions? Yes. Have you did I change my view about our star in the last year? I mean, it's yes, quite a lot because I was not an expert. I usually work much more. I'm not an expert, but it's I didn't think about our star. And actually, in part, the idea about our star came from a discussion. Maybe Claudio doesn't remember, but it was a discussion made by Claudio in someone else, Moritz Sularic and other people were discussing saving glut, and I think Claudio was the one very vocal saying, oh, no, the saving glut is not there. And I started to think whether there was something different, and then this is where this project started.
Very good. Stephanie?
Okay, so I can say something to two questions. Let's start with Alan. Of course, the famous paper by Ben Bernanke on the global savings glut said once, let's make it simple, East Asia started running very large current account surpluses. Beginning in the late 90s, we saw a big shift in the savings, and we saw a big increase in the supply of savings, and therefore the real interest rate fell. So that's the most important story, I guess. It's Ben Bernanke's global saving glut hypothesis. This is probably a good story, but we do see, beginning from the work stressed by Williams and Laubach that measures of R-star have been declining since the early 1980s, whereas that effect, for example, where somebody tried to use evidence on that, would date it 10, 15 years later. Then with respect to Isabel's question, suppose we take it as given that we are at a moment where the future might not look that similar than the past. Maybe there's more uncertainty, there's more chance of war, there's a green transformation that needs tons of investment. There is the AI revolution, which might need a lot of investment. So maybe one thinks about a period, maybe people forgot that word, but maybe some people remember Y2K. So there was this idea that once the year 2000 comes, maybe some computer systems will not work. And there was a whole literature on tons of investment to prepare for Y2K. In that particular period, maybe other shocks were also occurring, but it was not a period in which R-star rose, which is your intuition is right. If we have a big shift in the investment demand, we should see that we move up a given savings curve and R-star goes up. But if I think about also big investments that came with the IT revolution, these were all periods in which, at least in the data, unconditionally on net, the equilibrium interest rate fell.
Very good. John?
Many of the things I wanted to say have been said, so I won't do that. But going to Isabel, yeah, a couple things similar to what Stephanie said, but maybe I'll take a slightly different angle on that. If you look at first of all, origin story of Laubach-Williams, we were writing it at a time when productivity growth was really high. And trend GDP growth is very high. And the question we were actually asking is the neutral rate higher than usual? Now, the fact that all the talk about R-star since then has been how it's fallen. But the question we were asking was exactly, Isabel, the question you're asking me today. And so when you look at our estimates of R-star, which we have all the real-time estimates posted, and we did find higher potential growth in the U.S. during that period of 95 to 2005. We found our R-star estimates were elevated. You can see it in the picture and the things I showed. But as Stephanie said, elevated relative to a downward trend. So two things I would just say on this, and this is obviously purely advertising for our model, is it did catch these things in real time. It isn't the case that Laubach-Williams or HLW afterwards, you have to wait 15 years to figure out whether there was a trend GDP growth shift happening or higher productivity. You saw it in that model. You saw it in regime shifting models too. So I think the data will actually speak on major transformative changes of the kind that you talk about. Second is, of course, you're identifying the issues that we should be thinking about in terms of R-star, big shifts in demand or savings. I'll just mention, they aren't in the data yet. Maybe they'll be in the data in the future in terms of model estimates. And I guess the one thing maybe we might disagree on, and I think needs further thought, is I think we have to be cautious in adding things together. And so I'll use my AI thing that I say a lot is, there are two versions of what's going to happen with AI. I do not know the answer. No one here knows the answer. One version is 10 years from now, we'll be talking about, wow, this was the decade of really rapid 2, 3, 4% productivity growth and, amazing innovation and investment. And this is the world where my estimates of R-star and I think actual R-star will have risen a lot. That's one version. I think that's the one that you're highlighting. The other version is 10, 15 years from now, we're going to be looking back at this decade and say, wow, we had 1.5% productivity growth, which is the long run average in the US. And that AI thing, was really important to get us the average. And that's the Bob Gordon view, right? You go back 100 and some years, the US productivity growth has been roughly constant, had some periods of higher and slower. But what we've done historically is like, wow, we had industrialization. We moved people off the farms. We had automation. We had computers. We had the internet. We come up with the names that are associated with the actual miracle of free enterprise capitalism, which is delivering consistently over a century of more than 1% productivity growth. That is the thing that is the miraculous thing about things. Only afterwards do we really know, was it transformative and boosted growth to 2 to 3%, or is it the thing that just got us the growth? Either way, it's a good story because it gets you a continuing improvement in standard of living. Very quickly, I know I'm going a little long here. Short run versus long run, I think this is a very important issue. I focus on long run. I find, and I've always found short run R-star kind of complicated because it really reflects all the factors that are affecting the economy in the short run. Of course, as a student of Mike Woodford, there's a notion, as you mentioned, of a very short run R-star, but that's not what, that's not how I think about the economy. I think about it as a long run. Klaus Onum's question is a great question. It's one that I've thought about for a long time and don't have an answer for. My intuition, but could be wrong, is that our R-star estimates were artificially boosted because of the housing, first the stock market bubble, dot-com boom, then the housing bubble in the US were factors that were causing the real economy to outperform kind of fundamentals for quite a number of years. That made R-star look higher. When the financial crisis hit, the estimates fell. They fell like a rock, by the way. We didn't have to wait 5 years. They fell really rapidly. So I think there is an issue about what were the drivers and the timing. I think it was probably something that was already underway, but was kind of hidden because we had these other factors. And that's my last point, going to Ken Rogoff and his co-authors on the hundreds of years of R-star, and you can't pin R-star, R-star's changes over hundreds of years to any specific factors. And I think when I read his paper, I think that he actually identifies why you can't. And that is, there's a lot going on over a couple of hundred years. And he identifies financial liberalization, improvements in efficiency of our financial systems, of course, lower R-star or change that. Other things move the other way. I find these bivariate attempts to say, oh, it doesn't explain by this variable, so therefore we don't know what it is very misleading. I think it's because it's affected by thousands of things, and it's hard to get all of those in a model. I think that's why it's hard in any given work to say it's productivity growth, it's demographics, because I think it's a lot of things that are affecting it.
Very good. So now I'm going to go to the right of the room, and I'm going to take Richard, Kristen, Krishna, and Jordi. So that's the four. Okay. So front row, please.
Thank you. Richard Portis, London Business School. Some of us remember back only 10 years when R-star became a fashionable topic in the context of secular stagnation discussions. And that word, that phrase, hasn't appeared at all in the discussion this morning, and I'm curious as to why not. But let me turn to my preoccupation, which is financial stability. And there, I think, well, it was mentioned, I think Claudio actually mentioned it, but not very much. And I think we should be looking very closely at the consequences of low R-star, however we define it, however we measure it, whatever it is, underlying low real interest rates for extended periods of time, the consequences of that for financial stability. And we've seen them, actually, because we had a period of very low real interest rates. We had the search for yield. We had the vulnerabilities that built up during that period, and the consequences of those vulnerabilities when nominal interest rates went way up. And we haven't ended, I think. I mean, that chapter is not yet closed. So I'd be interested to know the views of the panel about the financial stability consequences of their views of R-star.
Because it's probably for proximity. Jordi's right behind you, if you can pass the...
Jordi and I are always together, you know.
Yeah, this one's for Claudio. So if, of course, R-star is not a universal constant. It may change over time as a result of changes in the underlying driving forces. But if we end up reaching the conclusion, as you seem to have reached, that at any point in time there is no well-defined R-star, and hence that central banks can actually influence the real interest rate permanently, I think we have to revisit the case for central bank independence, because it tells you that the central banks have much more power on say, income on having a permanent effect on income and wealth inequality that we admit now conventionally.
So Kristen in the corner, and then Krishna. Okay.
Thank you. Isabel mentioned several potential transformations that could affect our star. One you didn't mention was QT. Frederica showed us in a nice simple model how QE reduces our star. We've now had a pretty sudden shift where a number of major central banks have shifted from QE to QT. A number of the big banks have reduced their purchases during the pandemic by a quarter to a half. When you add that up globally, that's a pretty big shift. So do any of you think that could have affected or be affecting our star?
Very good. Krishna?
So happily, my question is very closely linked to Kristen's. Given the importance of long rates in the economy, presumably we should be thinking about equilibrium yield curves and equilibrium 10-year rates, not simply overnight rates, in which case the overnight R star and, if you like, the TP star, the new equilibrium term premium, would be jointly determined. And it seems plausible that in the new normal post-pandemic, the bigger difference might lie in the equilibrium term premium rather than the equilibrium overnight rate, given the high level of government debt issuance, the transition from QE to QT, but also shifting stock bond correlations that affect the equilibrium risk premium on government debt. So I'd be interested in the thoughts the panelists have on that topic, and indeed any implications for the joint setting of balance sheets and overnight rates.
Okay, very good. So again, it's probably efficient to go in order. So Claudio.
Okay, financial stability. Richard, I think that's critical. And if it didn't come across sufficiently clearly in my presentation, that I wasn't very good. I mean, think about the following way. You can think of what happened before the great financial crisis. And it was partly related to what you said, John, in two different ways. You can do the Summers. The Summers narrative is basically that there were factors that were driving equilibrium real interest rates low. R star defined as output at potential, inflation stable, blah, 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 that were driving interest rates low. But that was creating bubbles, and that therefore was creating financial problems down the road. That's the Summers narrative. So he sticks to the definition of R star as output at potential over time at a particular point in time and so on. Another way of thinking about it, which is the way that I prefer to think about it, is that a rate that basically causes, in the narrative, a major financial crisis a few years down the road is not an equilibrium real rate. And that's why when I talked about, so I think that definitions of ours proper, if you have a full model, a proper model, it would also, the good definition of an equilibrium real interest rate would also include what's happening to the financial side. And the definitions that we have now are too partial from that perspective. So that's point number one. Point number two, I think that the main reason for having independent central banks and independent institutions is to be within the state. I would like autonomous within the state, is their ability to take unpalatable decisions in the short run in order to get better outcomes in the longer run. And whether that means that there is a very precise function or a correspondence between real interest rates and equilibrium outcomes, I don't think that's affected by that specific issue that you raised. But we can have a broader discussion. On QT, it's very simple. Anything that affects the risk premium, because R star is defined as the riskless rate, anything that affects the risk premium will affect R star. So clearly there is an interdependence between QT and R star.
Okay, so first of all, I speak about a bit secular stagnation because I cited this the paper of Luca and Gianluca. It's like I didn't have enough time, but I think there's a great piece of work on low interest rate. I think also for financial stability, I'm going to be very fast. It's a very important problem to have this low interest rate, especially because I think there is a recent project by Refat that is here in the audience that show that the way which, so the banking sector and the bond sector, they transmit the interest rate in a very different way. So in some sense, the banking sector is much more correlated with the country fixed effect, correct me if I'm wrong, and the bond sector with the firm fixed effect. So it could be that having this low interest rate for a long period, we're favoring some firms over the other, and this is something that I think people should study a little bit more. Now, I will be very fast on the QT. It depends. So it's like, I think it's a very good question. In some sense, it's like even when we take out QT, there are still like two equilibria, so it depends. But I think it could be something that can bring you back to the other steady state.
Very good. Stephanie?
So I'd like to answer to Richard Porteous. So when we found our result that a decline in the natural rate depresses the level, not the growth rate, the level of output, we thought, okay, we are just rediscovering secular stagnation. So then we just did one test and tried to estimate our model across a period where the economy was always far away from the zero lower bound. And we got the same result qualitatively in the sense that a 1 percentage point decline in the natural rate depresses the level of output significantly. So that led us to conclude that maybe secular stagnation is one possibility, but it's not the only one.
Very good. John?
You know, the relationship between secular stagnation and very, very low R star is clear. I mean, it's the kind of the other side of the coin. And I think that the term secular stagnation isn't being used, but if we did think that R star was very, very low, I think people would be talking about it maybe more. On the term premium R star question, we should always celebrate when Claudio and I actually agree. Yes, I do kind of see it kind of mechanically. I think, we go in with QE, obviously QT is, still running. In the broader, there's a big question is how much does QE and QT have how big of a sustained effect does it have on the term premium? That's an open question. There's some great research going on that was at the poster presentations today. But I think that the mechanics of this are pretty clear. If you have a higher term premium, persistently higher, that is a reason you might think the neutral rate is lower. But I think to me the real question is these are all endogenous variables. Why is the term premium beyond policy levers? Why would the term premium be lower or higher? And those are the factors. So I kind of think of there's some factor X out there that's driving the term premium, maybe driving other things, including R star. So there is a mechanical relationship that Claudio mentioned, which I completely agree with, but there's probably a deeper reason to think about this. And I think one of the reasons term premium were so low was in the very low interest rate environment, not just low R star, but very low interest rate environment, very low inflation environment. Inflation risks were lower. Today, that's a different, it's a different reality that we've seen the last few years, and that's a reason the term premium would change. But it again, endogenously based on economic conditions. The last thing, if I can just say one very quick thing, I mentioned it in my presentation, but I think it's a really important point about where we are today in July of 2024. Relative to where I think many of us thought we would be just 3 or 4 years ago. And I'm going to use my HLW model as the way to talk about this, but it's true, I think, of any model that people use. Today in the US, the level of potential output in our model estimates right now for Q1 are almost exactly where we were forecasting in our model in 2019 Q4. We have had the worst pandemic, Russia's war on Ukraine, everything that's happened, and we at least in the U.S., potential output based on our measure, and of course GDP is above potential output, has not been harmed in a permanent way, and may in fact, if anything, I think potential is looking more positive for the reasons that we talked about. Similarly, in the euro area, our estimates say that we're most of the way back in terms of potential, but a slight difference. So I think it is one of the reasons I go back to maybe the world, hopefully, in terms of R star in the fundamentals, isn't quite as different as we were in 2019 Q4, and at least from that perspective, that's actually really good news.
Very good. So before I turn back to Claire, maybe I'll just make one point. Maybe it's not a coincidence that with the decline in R star in the last number of decades, there's been a big increase in macroprudential policy. We always say the first line of defense for financial stability is to have a lot of macroprudential policy, high capital ratios and so on, to kind of contain some of the obvious risk factors from low interest rates. But back to Claire.
So thank you to you all for doing such a tremendous job of outlining some of the real epistemological issues surrounding this concept, which, as you note, there's a very kind of feisty debate about at the moment. It's almost as though there's R-star wars when you listen to the views of some economists. So yeah, I'd like to close this morning's sessions and invite you all to join us downstairs for lunch. And please make your way back to the room for 2:30 for what promises to be one of the program highlights. Thank you. So before we begin the afternoon part of the program, just one small piece of housekeeping. Around 4 p.m, some of you will receive a text message asking you to complete a short survey on what you thought of this year's forum. So from handling financial stability to dealing with topics as complex as geoeconomic fragmentation to payment systems, the challenges facing the central bankers in this room are varied and complex. The next part of the programme will look at how 2 central bank governors will handle the challenges that their work presents. Ladies and gentlemen, I am delighted to introduce a conversation between Lesetja Kganyago, the Governor of the South African Reserve Bank, and Klaas Knot, President of the Netherlands Bank and Chair of the Financial Stability Board. Governor Kganyago and Klaas Knot, the floor is yours.
So thank you all very much for bearing with us in what will probably be something of an experiment. You could say an unmoderated conversation, but nonetheless, obviously, we did discuss beforehand that we'll try to bring some structure to the conversation. So this is about financial stability, so it's not going to be a cheery part of the program. But let me start on a positive note. If somebody had told me 2.5 years ago that the global community of central banks was about to raise rates by roughly 500 basis points on average within a period of slightly more than 12 months, and then would hold rates at that level for a significant period of time. And the only true financial instabilities that we've seen so far is a set of second-tier US banks that were kept out of the international regulatory perimeter, plus one significant Swiss institution, but an institution that already had a significant amount of governance-related issues that had nothing to do with the pivot in monetary policy. I would have immediately have signed up to it. Now, again, this is not a panel to be self-congratulatory, and luckily we have Richard amongst us. Luckily, we had the BIS this weekend reminding us that between the end of a hiking cycle and the first period in which financial instabilities can begin to manifest itself, usually a bit more time needs to pass. So there are still lots and lots of financial instabilities, or at least financial vulnerabilities in our parlance, financial vulnerabilities around there that we should worry about. And this is actually going to be the subject of the conversation that my good friend Lesetja and I are about to have. Now, before we go into these financial vulnerabilities, Lesetja, a lot of the discussion, of course, so far has focused on ECB monetary policy in relation to the Fed and other central banks. But we haven't discussed so much the experience from South Africa and, let's say, the emerging market perspective. So how do you look at this issue of monetary policy synchronization versus monetary policy divergence from a South African perspective?
Well, maybe before I could talk about the South African perspective, I just want to take this a little bit further, because the divergence that you have seen is not just in advanced economies. You have also seen divergence in emerging market economies. But also emerging market economies fared much better than in previous episodes. And what had been the distinguishing factor? What made the emerging markets resilient? First had been the issue of policy frameworks. Inflation targeting does work. And in countries that had implemented inflation targeting flexibly and more robustly, they had been able to fare much better. And I think that it is that explained why emerging markets were the first ones to start tightening monetary policy before advanced economies work. If you are an emerging market central bank, you are used to volatility of output and inflation. And when you see inflation beginning to rise, you know it is coming. You chaps could run surveys and try to impute these things from market expectations. Bottom line is that once the public start talking about the high cost of living, you know that inflation has become a problem. And what has become also useful had been a global public survey that was done by a surveying company that actually established that the public has become increasingly intolerable of inflation. But something happened in South Africa that I never thought would happen before, which happened in 2022, where there was a public demonstration against the high cost of living. Interestingly, that public demonstration didn't come to the central bank, it went to the presidency. I almost wanted to say, wrong address, you should have come here, and then I would have shown you what to do with that. A second point had been that the divergence in emerging markets has not just been about the stance of monetary policy. It also had to do with the policy experience. Those who had bad policies fared really bad during this episode, and those who didn't have buffers actually suffered. And unfortunately, those who do not have buffers, even if they had good policies, they suffered. But it had to do in the main because these were really developing countries and low-income countries. The third point that explained the resilience had been that the US response to this episode was also good. You might say that they acted late, but when they acted resolutely, which meant that global inflation peaked at lower rates compared to what we saw in the 70s, but also policy didn't have to tighten as much as it happened in the 70s, and as such didn't quite experience a recession. And the last point, class, that I would like to make, since we are focused on financial stability, I say to my chaps in the financial stability department, I pay you for one thing. So don't come here and tell me things are okay. Tell me what to worry about. So I'm trying to find something that I could worry about. And I asked them, what should I worry about? And the one thing that had come, class, is what could actually go wrong? And the question that then comes to me had to do with the levels of debt and the trajectory that the debt could follow. To put it into context, the OECD Global Debt Report states that debt in OECD, bond market debt in OECD countries in 2024 will rise to $56 trillion. If you take that back to 2008, it's an increase of $30 trillion. Of that debt, 40% is maturing within the next 3 years, and that is sovereign debt. Corporate debt, 37% of that is maturing within the next 3 years. So whether it is repaid or it is refinanced, and I think most likely it would be refinanced, is going to be refinanced at rates that are higher than what that debt was raised. And that could raise potential issues. And my question to you, class, with you being the chair of the Financial Stability Board, but also being the governor of a central bank in the Euro system, is to what extent you are concerned about the financial stability risks that could emanate from this elevated debt situation and the trajectory that it follows.
Well, Lesetja, let me begin by saying that obviously the risk of high indebtedness is clearly not a risk that is restricted to emerging markets only. We've seen an episode in the UK related to a very rapid repricing of a public debt trajectory in an advanced economy. there is no escaping from the notion also at the lunch conversations, etc., that the issue of fiscal policy and sovereign debt is back on many people's radars. It is indeed true that countries differ very much in terms of the average maturity of borrowing, fixed rate versus flexible rate borrowing. So the day of the reckoning can be postponed by having a lot of fixed rate borrowing. But if the inflation outlook is such that the rates will continue to have to be high for an for an extended period of time, then of course at some point that rollover risk will manifest itself. And I think there is still quite some rollover risk in the pipeline here. Now, you mentioned high indebtedness. This is of course not the only financial stability vulnerability that we worry about. By the way, in our parlance, we talk about financial stability risks as being the confluence of shocks, which we cannot predict because we don't know where they come from, and vulnerabilities, which we can actually manage and try to remedy. Other financial vulnerabilities that I could think about have of course to do with the still quite rich valuations in financial markets. And the question that comes to mind there is, for instance, is a risk like geopolitical risk, the risk of geoeconomic fragmentation, is that risk sufficiently priceable by markets? Have markets taken that risk sufficiently into account? Suppose that were to give rise to a correction, what would then happen with the, let's say, the non-bank financial system? So far, the core of the financial system, the banking sector, has managed relatively well. In part, I will say, because of the financial reform agenda that we rolled out after the global financial crisis. But there is a host of issues in the non-bank sector, which is different from the banking sector, because it's not so much about capital, but it is about liquidity mismatches, and definitely, if they are combined, also with forms of hidden leverage popping up. So that's a vulnerability that I would ask attention for. And of course, geopolitical risk also lead to more active, let's say, cyber risks, more involvement of state actors in cyber attacks. And then, of course, there is also the issue, what does it do with capital flows? You are a representative of an emerging market. So to what extent can these vulnerabilities also give rise to more volatile capital flows? And that would be my question to you, Lesetja. From an emerging market perspective, do you worry about NBFI and capital flows?
You know, I was about to interject you, Klaas, and come back to one thing. Because we keep on giving the child a new name. You know, this thing was, we were worried about shadow banking. Then we said, no, maybe it's not quite shadow banking. It's bank-like financial institutions. Then we said, no, maybe that is not quite the term. Let's call it market-based financing. And then now we're calling it the NBFI. You know, it's the same child, okay? It's just having different names all the time. And the thing for me, when you say, are you worried about capital flows? I ask myself, because you see, I spent a lot of time going to key world financial centers to try and get investors to put their money in the South African economy, whether it is in the bond market and in the equity market. Then I come to a conference like this, Klaas, and then you tell me about the dangers of capital flows. Then I ask myself, which part of my job is bad now? Because I have to go around trying to get capital to come to my country, only for me to come to the meeting to tell me that capital flows are so bad, they might actually lead to financial instability. But point here is that capital flows are easier to manage if you have robust policy framework such that capital goes into the areas where it is supposed to go. Well, let me give you the South African example. So in the 2000s, in the build-up to the great financial crisis, the bulk of capital flows that were coming into South Africa were non-debt creating flows going into the equity market because they were looking for growth and some of them were looking for infrastructure. We got into the period after 2009, a period in South Africa that we characterize as state capture, where bad policies started to set in. And the nature of the flows changed, and they tended to be more debt, creating flows, and they tended to go to state-owned enterprises, which almost turned out to be zombies, and government had to bail them out. So the point that I wanted to drive to is with a prudent macro policy framework, rule of law, functioning institutions, and so forth, capital flows would be good. Capital flows can reverse, but they reverse because of the nature of global finance. If there is a concern about risks, capital will flow away from the risk and go to where either risk is low or the returns are better. And so that is what you would actually be faced with. So to the extent that there would be countries that are worried about capital flows, it would be that, well, maybe we know the policies are bad and capital might just flow out. Because if the policies are good, these things seem to be mean reverting. And so capital would flow out and it would flow back in. And our experience had been to allow the exchange rate to take this shock on behalf of the economy. So when capital flows out, the exchange rate depreciates, and when they return, the exchange rate appreciates. But it becomes also particularly important for us when this becomes a shock absorber, because most of the major emerging markets now do not suffer from what Ricardo Hausmann called the original sin. These flows tend to be denominated in domestic currency. So when there is an outflow, the investors would know that if they have just moved out of panic, not because the policy have changed, there is a price to pay, because those who stay behind get to experience better returns.
Well, in that sense, Lesetja, let me remind you also that the fact that we moved away from the word shadow banking was exactly sort of to underline that this word perhaps had a little bit too much a negative connotation. So there is nothing wrong with sort of market-based finance in that sense. That's why we try to move away from a more neutral term, well, non-bank financial intermediation. It's not the greatest of all terms, but at least it was meant to illustrate that actually there's nothing wrong with capital market finance in and of itself. On the contrary, I think with my European hat on, I would say we could use a little bit more capital market financing rather than this heavily bank-dominated financial system that we currently have. But it is interesting that the concept of resilience, of course, in the NBFI space is a different concept than the one in the banking sector. In the banking sector, it's much more focused on buffers, on capital within the core institution. Within the NBFI space, this is much more heterogeneous. It's about liquidity imbalances. It's about managing such liquidity imbalances. It is about strengthening the core players like investment funds, money market funds, etc. But it's definitely also about some cross-cutting issues like liquidity preparedness for margin and collateral calls. We saw a lot of that in March 2020. It is about pockets of hidden leverage. Think about the Archegos case that manifested itself. So it's much more diverse. It's much more about sort of making sure that the markets be brought in a position where they can price the risk accordingly, rather than focusing solely on the entities. Now the trick.
That's a very important point. But this, as you talk about this, so we talk about these flows. One of the things that we established is the following: South Africa is very far from Ukraine, and yet when Russia invaded Ukraine, capital flew out of South Africa. It flowed out of other emerging markets. So clearly now the issue of the geopolitics and geofragmentation plays its role. It becomes a challenge. How do you think about geofragmentation and how you think it could be impacting on this area of work?
Well, actually, I think geoeconomic fragmentation has, of course, real effects on trade and on impeding technology diffusion, which has a negative effect on productivity growth on either side of the fence. But if I take it more into the financial stability area, the biggest drawback I see from geoeconomic fragmentation is that most of the challenges that we are being faced with, most of the, let's say, financial vulnerabilities, are truly global in nature and can only be remedied with a global approach, with a global cooperative approach where everybody is willing to play his or her role. That is the reason why the FSB was established. That was also the reason why the Financial Stability Board in 2009 became a G20 committee. Its forerunner was the Financial Stability Forum, which was a G7 plus forum. The Financial Stability Board is a G20 plus institution, and that was meant to reflect that the challenges that we face are truly global in nature. Think about climate, think about crypto. Another reason to worry a little bit, I think, is that when it comes to crisis management, imagine that we would have another global financial crisis, 2007, 2008. We all remember the Pittsburgh 2009 summit where sort of countries came together and agreed on a globally concerted sort of policy response. Would it be possible in today's world to come up with a similar response if a crisis like that were to repeat itself? Or would we first enter into a phase of recriminations, of mistrust, etc.? So the potential and the lower potential for international cooperation, that for me is the largest financial stability risk that I see emanating from this geopolitical and geoeconomic fragmentation. Now, this is very much from the FSB's perspective, but as you are well aware, you as South Africa will be taking over the G20 presidency next year. And my observation is that this is actually also, to some extent, hampering the effectiveness of the G20. So do you have any plans already in, let's say, in shape for next year, how you want to go about this when you have to chair the G20?
Well, T20 for think tanks, Y20 for youth, W20 for women, L20 for labor ministers, 2020, 2020. This is becoming a big industry. And so we want about this that what you have is that the G20 agenda keeps on adding up. Nothing gets dropped. The stuff that the G20 was found to deal with, we still have to deal with those. And yet, there is more and more added onto the agenda. And just thinking about the South African agenda as we go into the 2025, we look at this and I look back. And you know, I did this as a young civil servant. But if the work of the G20 is going to be reduced to negotiating a communique, we have a problem. We are not dealing with global issues that are confronting us. And any country could find one paragraph in the communique that they do not like, and we will have no communique. So why travel? Why travel for 16 and a half hours to listen to people argue about one paragraph and then eventually decide, okay, chairman, you can go and make your own statement? Well, you could have as well just sat at home and asked the chairman to make the statement, right? But we are reducing the G20 to a communique thing. Can we look back and say that what is the agenda of the G20? And obviously, this thing has been elevated to the heads of state. That is above my pay grade. So whatever I'm going to be telling you is what we are trying to do with the finance track, which I'm coming to think of it, that the FSB's value add was having the treasuries in the room, the central banks in the room, the regulators in the room, and I'm afraid that the treasuries, apart from the ministers, below, the treasuries are starting to drop their level of participation in the FSB, because that is the work, the finance track has really migrated to the FSB. And if the G20 was to look back and say, what are the achievements of the G20 since the great financial crisis, you will find that it is the finance track, the regulatory reform agenda. That is what had been done. Now that we talked about the debt, I mean, there is debt distress now in low income countries. It is a concern. The G20 common framework sounded great in design. It is too slow. It is not quite working for the countries that are in distress, and it doesn't take into account that there is a lack of capacity in many of those low-income countries to successfully negotiate with well-resourced creditors. And maybe what we should be thinking about is who is the broker that could come into the room. The IMF tried before, there was a pushback, but maybe we could get the IMF to work then on the side of the countries rather, and help the countries to be able to prepare themselves into that. The second part of the finance track, which is important for us, this is the first time that an African country would be chairing the G20 at a leaders summit. And one of the things that we established had been that the African continent corridors of remittances are amongst the most expensive around, and we're going to be spending time on not adding new things to the payment agenda, because I co-chair the CPC in the FSB, just to lift that agenda and take it to the next level. We have set targets for 2027 and for 2030. We have only had 2 years now. I don't think that we should be despondent, because we spent the time sorting out the measures and so forth. And that is the work that we would like to take forth. And lastly is that because work of the finance track had almost migrated to the FSB, is almost, you guys can talk about those in the FSB. Here we would like to deal with other things, and to just make sure that the FSB continues to play a meaningful role in the G20 agenda.
But just proceeding on this global payments roadmap, which I believe is absolutely crucial and is very, very, very essential. At the same time, South Africa is also part of the BRICS, you know, the famous abbreviation. And what we are reading in the press is that actually, and here I think geo-economic, geopolitical fragmentation and payments sort of come together, that the BRICS are thinking about setting up their own payment system. So my question to you would be, how does that relate to this work in the G20, where we try to combine fast payment system, where we try to work on global interoperability, and at the same time building these separate structures? Can these two be sort of reconciled?
Well, if you doubted whether sanctions work, this is it. It might have worked in the wrong direction, but they work, right? So finance has been, so to say, weaponized, and you're cutting people out of key systems, they will find alternatives. I do not think that the economics makes sense, but when you start to say to people you are going to be cut out of global finance, people will create a different environment. And we must think carefully about whether this is an instrument we wanted to use. I got worried when I had to speak to some reserve managers, and they were talking about, reserves can be seized. We better start looking elsewhere. Let's look at alternative markets. Let's look at different custodianship and so forth. We are going to have a fragmentation. Does that mean that we should not be working towards a framework that would enable all of us to get? Absolutely not. We should continue the work, because it is those of us who are on the fringes of the global financial system who will end up paying the price for the fragmentation.
Excellent. So I think this was a very good example of how you see that geopolitical risks are actually interfering with the work of a global platform like the Financial Stability Board. I could add just one more area before I think we should also draw in a little bit of the audience. And that, is, of course, has to do with digital currencies and particularly cryptocurrencies. That's another area where in today's world, I believe you can take a server under your arm to any place in the world, you plug into the internet, and you can start issuing crypto assets. So the FSB has come forward with two sets of recommendations. One set of recommendations for a global regulatory framework for crypto assets and crypto asset activities, and another one for global stablecoin arrangements. But of course, the strength of these recommendations will only be decided by the scope of its implementation. If we allow non-cooperative jurisdictions to continue to function and attract these crypto asset activity, then probably we will not be able to deliver on the goals that we've set ourselves in this area. And I think this is one more area where we have to make sure that whatever is happening in the world, that we try to fight each other at the FSB table, and that we come to a common understanding that we have enough information sharing across countries. Because in many of the emerging markets, you're well aware of the concerns that, for instance, US dollar denominated global stablecoins would take over part of the payment system in these countries. That's, I think, a concern that we should take very, very, very seriously. And then a final example where I think global cooperation is absolutely key, and that has to do with climate change. There is only one global climate. And to that extent, I also wanted to ask you, Lesetja, because South Africa is a little bit in a peculiar position when it comes to climate change. On the one hand, you stand to suffer quite a bit from climate change, rising temperatures, drought, floods, etc. At the same time, your energy mix is still heavily dominated by coal. There are issues with energy outages in the country, etc. How do you sort of navigate between these two challenges?
It's the same. The only reason we have economists is to help us deal with trade-offs, and otherwise we do not need economists. Okay, so we face the trade-offs, and some of these trade-offs are intertemporal, and so we have as you correctly pointed out, an energy system that is very much based on coal. In the short term, we are going to need those power stations that are fired by coal. In the medium to long term, we are making the transition. Our just energy transition plan is well thought out, and we think that it would be. And these short-term trade-offs are very important. And since we are in Europe, so when Russia invaded Ukraine, what happened? You were going to face a cold winter, and I didn't even hear the narrative change. All that I saw was that the ports of South Africa were very busy carrying coal to Europe. It was correct, because you couldn't say to Europe, it's transition from hydrocarbons at all costs. You were facing a situation where you needed energy now, and you had to get that coal. That is exactly the challenge that we face in South Africa. We are facing an energy shortage, and we have got a resource called coal. And so to the extent that we are not building new coal-fired power stations, we are just getting the existing ones to continue to work. We are making this transition. Give you this perspective. In 2022, we generated 2.3 gigawatts of renewable energy. By 2024, we are generating 5.9 gigawatts of renewable energy. Our national energy regulator says that the projects currently underway will add another 9 gigawatts to the grid. So the transition is taking place. And part of it had to do with the fact that we were facing the constrained energy situation, and yet the fastest way to deal with it was to actually bring in renewables. I wouldn't say that because we're going to have wind, but in the main is solar. I won't say to the UK that they must do solar. I'm sure they can do it and it would work. But we have got like 350 days of sunlight, right? So it's a competitive advantage. So we can do that, and that is the transition that we are making.
Excellent. So there is still some time left for questions from. I think we touched upon a very, very wide range of subjects, but any questions you may have on, let's say, global financial stability related matters? Who wants to take the floor? Well, Richard, please. Yes, we take a couple of questions and then if there are more, please raise your hand. Yes, Harold, okay.
Thank
Richard.
you. I'll just start with a remark on one of the initial statements that, that was made about who's responsible for inflation. Well, I'll tell you, when inflation is going up, it's the central bank. When it's coming down, it's the government. That's what we found out in the United Kingdom. That's part of the story that's been told in our election campaign. Anyway, I'll pass on to the real issues, which are macroprudential. And 2 points. One, I'd ask you, we're talking about volatility of capital flows and to some extent the role of non-bank financial intermediaries. Is there, in your view, both of you, is there a role, should there be a role for capital controls as part of the macro-pru armory? And the second issue is on global payments, and I'll put that together with Klaas's remarks about crypto. I would be concerned that these stablecoins could become a significant vehicle for international transfers that would be really outside the domain, outside the control, outside the regulatory perimeter, and is that something that worries you?
Excellent. The gentleman over here.
This was wonderful, thank you. I wanted to ask you, if we didn't already have this language of advanced economies and emerging markets, do you think we'd have the current grouping of countries into these groups? And if we were trying to do this, how would you define an emerging market in terms of policy terms? What is it that makes these countries different from advanced economies?
Excellent question, thank you. There, Harold, yeah.
Governor Konyago, you spoke about the weaponization of the financial system, and I very much agree with that perspective and how that's going to potentially change the financial system in the future. I'm hoping you can elaborate a little bit more on that, and in that context, maybe also get back at the crypto question that Richard Portis raised. I mean, some countries view crypto as an opportunity rather than a danger, right? Because it offers an alternative to the controllable financial system, and we have seen what happens with control of the financial system. El Salvador has tried, not very successfully, but is this an option for South Africa, or what's your stance on that?
Maybe you go, and then I'll pick up the pieces where you leave.
Well, I wanted you to pick up the crypto and the global stable coins, and then since there was a specific question about South Africa, I'll come on that, and I thought that I will take the other two. Advanced economies, emerging market economies, I'd go through the data, and I found that the IMF and the World Bank has this language, low income, middle income, upper middle income, right? At the end of the day, for me, it is, I'd look at our country and say, where are we relative to other countries in the world? And if the other countries are ahead of us, then we are developing, and we have got to be try and see whether we are going to catch up with that. I just wish one day there would be an egalitarian world, and we wouldn't talk about developed and developing, because that we will all look so much alike, but that is not going to happen in our lifetime, it looks like. Role of capital controls. Let me say this, that there's sometimes an illogic about it. You want access to other people's savings, but you don't want them to have access to yours. It's like a different kind of protectionism. Now, we have in South Africa, we are stupid enough to call them exchange controls, because there are people who are clever around the world who call them capital flow measures. And for a long time, we had this. And the whole idea was that apartheid South Africa believed it wanted to create a lager and insulate itself from the rest of the world. So it wanted to capture all the capital there. With democracy, we said, we want to open up. And we were opening up. And at some stage in 1998, we actually got advice from the IMF that said that we think you are moving too fast in your liberalization. Can you please slow down? And eventually, by the 2000s, what we said we would do is to reform so that we are in compliance with the OECD code on capital liberalization. And that is the approach that we have taken. Can this be used for macroprudential? It's something that exists in the toolkit. Like many macroprudential tools, I don't think its efficacy has been tested. And in a way, it could also be dangerous, because at the time that you decide to put the capital flow measures, the interpretation of capital could be, you know something they don't know, and they panic even more. And then you might just find that you actually make the problem worse than it would have otherwise had been. But they are there. They are a tool that countries could use. They should be used judiciously.
Okay, let me pick up the question, Richard, you raised on cryptos and payments. Within the FSB, if we look at financial innovations, we always have this overarching frame that we want to harness the benefits while mitigating the risks. Now, if you apply that phrase to the crypto area, there is a legitimate question still out there. What actually are the benefits to society of a lot of the crypto asset, global stablecoin activities? If you take the three functions that we have of money, none of them currently satisfies these three roles of money. But at the same time, what we see is, of course, there is a strong investor demand for crypto assets. There is no global agreement to ban cryptos, let alone if there was an agreement whether we could actually operationalize such a ban. So the emphasis from the financial stability perspectives has come from, let's say, two things. First of all, to the extent that deficiencies in our traditional global cross-border payments world were one of the sources of this crypto space to flourish, we should address these weaknesses. That's the reason why we have this global cross-border payments agenda, a G20 agenda, again, that you, together with Fabio Panetta from Banco d'Italia, that you coordinate within the FSB. And the other one is to try to come up with an as convincing as possible global framework of regulating crypto asset activities and global stablecoins. Regulating the well-known risks in this space, like AML, CFT, like insufficient separation of funds, intransparent governance structures in these crypto conglomerates, etc. There is a host of very traditional investor protection issues that also play a role in this area, and that we have tried to capture as much as we can. Actually, Andrew has been leading this exercise within one of the standing committees of the Financial Stability Board to come up with a set of workable standards to mitigate this risk as much as possible. But then again, let me conclude by saying its effectiveness will depend entirely on the preparedness of individual jurisdictions to implement and to collectively also think about a regime, how to deal with non-cooperative jurisdictions. Because at the end of the day, I repeat myself, you can take your server under your arm to any place in the world where you can start up these activities. And that the jury is simply still out as to how effective we will be here. Good, there is still 1 minute left, so at least one more question. Maybe we have a few minutes run over. Yes, to the left, the lady in the green there, please.
Hi, thank you. It's a question for the Governor of South Africa. I was really interested in your comment that inflation targeting works, because over so much of my career, there's always been this perennial sort of challenge to the framework after the GFC, you know, what about asset bubbles? And then when we were in this period of below target inflation, that maybe we should change elements of the framework. And again, more recently, people talking about raising the target or putting a band, et cetera. We haven't talked much about it today, but just really interested to hear about, from your perspective, what do you think are some of the lessons for the DM economies? You know, we maybe shouldn't be throwing away the inflation targeting framework just yet.
Is DM developed markets, or is it these concepts move a lot? I will paraphrase one political scientist who said that if you thought democracy is bad, try the alternative. And I will put this and say that if inflation targeting framework is not working, what is an alternative monetary policy framework? We have come a long way, and in developing countries we had countries that would have exchange rate pegs. There was a time when countries were pursuing money supply targets, and in my own country we had a framework that was called an eclectic monetary policy, which basically meant that the governor could justify moving rates at will because they just pick up which indicator and says, if you look at this indicator, therefore, that was problematic. And I think that the lesson of the inflation targeting framework is that it is clear, you have got an anchor, and if you have an independent central bank to execute that framework, even better, and just understand that the flip side of independence is transparency and accountability, because that is how you sustain the framework. And I think that we should not be too defensive either. We should allow society, if in a democracy, if people want to question the framework, we must engage with that. Because I don't know, maybe there might be an alternative. So far, all the alternatives that have been put on the table have not been credible. And so this is the framework that actually works. And now and then, I think that a number of central banks, from the ECB to the BOE to the Fed, have had revisions. They tweaked the frameworks to make sure that the framework is more robust. And apart from that, I am not sure that I can help you.
Thank you very much. I think this concludes today's discussion. I had no doubt that we would have more than enough ground to cover, and indeed there is still, I think, a whole array of issues that we didn't touch upon. But nonetheless, thank you very much for being with me here. Thank you very much for being with us, and that concludes also this session.
Thanks.
Thank you.
Thank you very much, President Knott and Governor Kganyo, for a very, very lively and frank discussion on some of the pros and cons of the current institutional arrangements governing global finance. I now want to turn to the final part of our programme, which is to award, with the help of your votes, along with the work of our expert jury, the best paper from some of the world's most promising young economists. I'd now like to invite onto the stage to present the award, President Christine Lagarde.
All right. Thank you so much, Claire, and allow me to thank you very much as a master of our ceremony here. You've done a fabulous job guiding us through the timetable. So, there was going to be a video, but we skipped the video in the interest of time. So I'm totally lost as to the synchronization. Yeah, somebody's happy because they want to go and play golf or do something else. So, this is one of the highlights of each edition of Sintra, and it is the Young Economist Prize. It has been a great pleasure to have all the 10 finalists. I think the 10 finalists should be joining me, shouldn't they? Because if I say thank you to them, they should be around. So come, please. Thank you really so much to all of you because you have shared with us your research. Many of us in the audience, highly qualified and respected academics, governors, and experts of all kinds, have actually been impressed by your presentation, by the depth of the work that you did, and by the clarity with which you've explained it to us. So thank you so much for having done that, and congratulations, because as you know, there are 10 of you. One will have the prize. But think about the other 70 who are pre-qualified to also be amongst the finalists and who have not made it. So you are really the la crème de la crème on this occasion, and you should be very proud of that. But of course, a jury was at work. And the jury was composed of Jordi Galli, Hélène Ray, Jiri Slachalek, and Isabel van Steenkist, as well as Philip Hartzman. So all of them have worked hard, have read all your papers, have scratched their head to decide exactly who was the best and who should be the finalist. You have to know that they had to go back, skipped lunch for most of them, and had a special session to finally decide which one would be the prize winner. And that speaks to the quality of the work that you have done all together. But one of them has to be selected, as the jury said. Jury took note also of the votes that we all registered, and it was with some trepidation that they decided that this Young Economist Prize, who is 10,000 euros and a trophy that will be presented to me in a microsecond. Thank you for the trophy. Thank you. That I announced that the winner, and I would like to ask you to step forward as I mention your name, is Svetlana Nenova. Please step out. Congratulations. For those of you who don't remember her presentation, Svetlana is a PhD student at the London Business School, and she has produced a paper named Global or Regional Safe Assets, Evidence from Bond Substitution Patterns. She provides novel empirical evidence on the portfolio rebalancing of mutual funds in international bond markets and on monetary policy spillovers around the globe and across euro area countries. This work provides valuable insight about the transmission of monetary policy and sets an excellent example for young scholars to do highly policy-relevant work using European data. Warmest congratulations to you. If you don't mind coming to receive your award.
Thank you. Thank you very much, President. It's quite a heavy one here. Thank you. Thank you for this award to the President, to the selection committee, to anybody who voted for my paper or just stopped by to talk to me at the poster. Thank you very much. I'm very deeply honored and also quite surprised given the amazing competition. I'd like to thank everybody who's guided me on during my research journey. And I want to also say that this project was very much motivated by what I saw in financial markets following the global financial crisis, what I saw in European sovereign debt markets during the crisis after that in Europe. There was an increase in market fragmentation, and we didn't, and I thought with more granular data, international data, both on Europe and the US, I could fill this gap to some degree by understanding how this market fragmentation arises and to be able to track it a bit better. So I'm glad that this has done a full circle and is now useful to policymakers as well. And I think really this is my takeaway from the conference here is really that the reward for us all is that we can kind of see very tangibly what are the policy implications and what is the usefulness to society of what we have spent many years working on by ourselves. So I think that's a reward for us all, and please join me in a round of applause for everybody for all the finalists.
So you can stay here on the podium. I'm just going to say a few words by way of closing, because this is now the last few minutes before you are released and you can go and do something else. So I simply want to thank all participants in that conference. And I have to say that you've identified very beautifully the relationship between the academic work and the drawing from that academic world that policymakers can actually benefit from. And it's not so often the case all the time that policymakers can, in a spirit of congenial, convivial, and occasionally consensual, not always, can actually compare notes, share views, pick the brain of those who spend a lot of their time thinking about the decisions that we have to make on a regular basis, sometimes not always with the benefit of the deep research and the deep analytical work that is done by many of you in this room. So thank you very much for that. I thought that the conference actually provided a great opportunity to consider the past, to analyze the present, and to plan for the future. And incidentally, Lesice, where are you? Lesice, there you are. My first G20 actually was in South Africa. It was not a leaders' summit, it was a finance ministers' summit about 15 years ago. And you were the doers from that G20 groups. So the items that you've identified, the two items that you've identified for the financial channel, I'm certain that you will take them further. And I very much hope so, because particularly in relation to cross-border and cross-currency payments, there's a lot of work that has been done, but now we need to just act upon it and take it further. And it's not just for the benefit of having good control of the system, but it's also for the benefit of all those who are paying massive fees and commissions on the remittance from developed to soon to be as developed countries. So when I look at all the papers and the contributions that we've had the benefit of, when I look at this past bucket, if you will, you've helped us analyzing and dissecting the main feature of past policy cycles and identifying the drivers of the inflation surge in the post-COVID environment. Okay, we will continue debating probably for long as to whether it is demand or whether it is supply or whether it is a bit of both and which one of the two prevailed over the other. And some of us might even say, look, it was just so big anyway that it didn't really matter in terms of what policy measures we had to take. But I hear what you say, Christine, about the fact that Christine is gone. No, she's still here. Wonderful. I hear what you say about having to really get to the bottom of the roots of it. Turning to, and thank you, by the way, because I thought that was really a beautiful gesture on your part to say we've accumulated all this amount of data since 1880, and it's all out there for you if you want to prolong research and do more work. I think it's really a wonderful way of sharing the work that you've done and taking it further, and I'm sure some will do it. Turning now to the present, you helped us identify what are the lessons from the past for current policy and how to think today about the natural interest rate role in the current environment. And I don't know if John is still around, Claudio is certainly still there, and Stephanie and I can't see all of them. Yes, there you are, both of you. Thank you very much under the leadership of Philip for helping us with trying to sort out exactly how it can help and how we can try to identify the gender of angels with a level of certainty that will take us to the star. Thank you, Claudio, for this remembrance. We have the same in French, by the way. Le sexe des anges. I think you've also helped us identify what are the risks to the financial system. The last panel was certainly a case in point. And one panel that was a little bit unusual, probably under the guidance of Isabel, was the way in which geopolitical fragmentation, geopolitical development, political development actually matter enormously and can raise issues going forward for all of us policymakers. As to the future, I know some of you will debate for long as to whether this paper on biodiversity and the natural capital was relevant or not, or whether we were going way beyond what is the natural remit of central banks. I think that is the beauty of this kind of conferences, to actually step out and move into the future. And I think history will judge, and I bet you that in 10 years' time, we're celebrating, by the way, the 10th anniversary of Sintra. But in 10 years' time, if some of you are still around, I won't, for that matter, because we have, terms that are very finite. Some of you will actually be surprised that these kind of research and work is actually critically important and should not be treated casually, including by central bankers, but that's another matter that we can debate further. Improvement of productivity, the role of artificial intelligence, all of that was also brought into a sort of projecting into the future what the impact will be, and for all of that, again, thank you so much. We will take it like bees pick up the flowers that you are in order to make honeys. We understand that pollination is important. Sorry. No, I am focused on price stability and obsessed with it, rest assured. So before we all go away to other things, before we have dinner tonight all together, I would like to recognize a number of people, and sometimes I will just mention categories. So first of all, I would like to thank all members of staff of the ECB who have worked long and hard to make that conference a success. And for those of you who only think about those who have produced research, who have harnessed the intellectual capital of the contributors, it's not just that, it's critically important, but it's also who plans for lunch, how do you organize the ways in which those sequences happen seamlessly, without any problem, and how you all satisfied from you tippy toes to your hair, which goes into all directions with the wind. I would like to thank my executive board colleagues, all of them who have been tremendous leaders of the various panel discussions that they've monitored, moderated, and participated in. Thank you so much to all of you. All contributors of their research papers, sometimes 90 pages long, granted, but fascinating and really interesting and important. And I would like to give a special thanks to two categories identified by nationality. And that will go, first of all, to our American friends, because despite the fact that tomorrow is Independence Day, they nonetheless accepted to spend the day before Independence Day with the crowd of the most independent people on the planet, central bank governors. So thank you for that. You've really engraced us with your presence, and I hope that you will celebrate the 4th of July with joy and rejuvenated and excited by what you've learned today. The second category that I would like to think is our UK colleagues, because some of them have a little business to conduct tomorrow. It's not about Independence Day, it might be about transformation, but I would like to distinguish amongst that group of British colleagues, in particular Andrew Bailey, who has mastered the consumed art of saying nothing for 3 days, and for that I would like to congratulate you. So thank you to all of you. You're now free to do whatever you care to do, and we are all seeing each other for an exciting dinner that our friend Mario Centeno has organized for us. And Mario, thank you for your hospitality in your beautiful Sintra one more time. It's been a joy. Thank you, Mario.